I'm
Okay,
recording
thank you
it.
very much.
Perfect. Okay, so guys, let's get started. Um, this is what you can expect today. 6 modules. The first one, an overview of the Act, just basically gives you an idea of what happened before we had the NTA. Why is the NTA important? What is the main objective? What are they trying to achieve by implementing the NTA? The second module, we look at consumer credit institutions. So now they refer to all the key role players in the credit industry, all of the important people we need to get a credit transaction from beginning through to the end when signing a contract. Then module three, we look at the actual credit agreement. So we look at what is a credit agreement? What are the different types of credit agreements? When will an agreement be unlawful? That type of things. What are the documents that we require for the agreement itself? And then module four, I think this is almost the easiest module, and that's consumer rights. So this is basically the whole reason behind the NCA is to protect the consumer, to make sure consumers are taken care of and are not being taken advantage of. So that's a quick and easy module we discuss. Then module five, affordability assessment, over indebtedness, as well as reckless credit. So basically, it's a summary of what are the requirements before granting credit? What happens if we grant credit to someone who cannot actually afford it? And then if they have more credit than they have income to pay for this credit, then a consumer will be considered over indebted. But we will discuss it in detail. And then the last module, module six. So that's complaints and disputes. And complaints and disputes, I almost feel like in nowadays we have complaints everywhere we go. So this is just a guidance on how the National Credit Regulator will handle a complaint, what is the method that they need to handle a complaint, and who will complaints be reported to, or what can be the outcome of specific complaints. Okay, so before we start, I'm going to ask you guys questions. I don't expect you to answer it 100% correctly. That's why I'm here today. But I just want to get an idea of, what you are understanding under a specific topic, and then we'll take it from there and I'll explain it to you whether you are on track or whether you just need to move your mindset a bit. Okay. So before we start, why do you guys think it was necessary for the National Credit Act? What do you think happened before we had the guidance of the National Credit Act? Any one of you can answer. Otherwise, I have to pick with someone, and I hate picking on someone. So I'd rather have you volunteer. Anyone? It's not a trick question. You are muted. Timbiso, you are muted. So if you unmute, there we
Sorry,
go.
sorry, sorry.
No
Yeah.
worries.
Yes, I think one of the major reasons it was because the consumers were being exploited and they didn't know their rights and where to go when they experience problems and stuff like that. I think though that was one of the major reasons. I don't know if I got it correct.
Okay, so that's perfect. So you are on the right track. So before, can you guys imagine if we had no laws? We'll just do whatever we please, right? And basically the same happened in the credit industry. So without clear guidelines of the expected behavior, we had disruptive behavior or behavior where people were taken advantage of. So people were granted credit, but we didn't even consider whether they can actually afford the credit, resulting in over indebtedness. Or people were charged interest rates by credit providers, but the providers just charged whatever they felt like. Can you imagine? Okay, today I'm in a good mood, today I'll give it to you for 6%. But tomorrow I'm in a bad mood and now you're paying back with the interest rate of 20%, just because there were no clear regulations on what we are allowed to charge. And the consumers were basically so misinformed that they weren't even aware they were being taken advantage of. They just thought that's the way it's supposed to be, which it's not. So the NCA was required to regulate the credit industry to make sure everyone's treated in the same way, everyone's treated fairly, and that before credit is actually granted, sufficient checks are done to make sure that the consumer can actually afford the credit. Okay. So if we start with module 1, the first thing that we see is with an overview of the Act, they give us 2 dates. So if you are a person that likes to remember stuff by connecting an image, I'll try to make sure to connect certain images throughout the training that you recall tomorrow in your exam. I had a lady the other day and she says, you know what? I couldn't remember the word, but I just remembered the explanation of what you said about the image, and I was able to answer. So I'm hoping that works for you guys as well. Okay, so the first date that they give you was the enactment date. On the 15th of March 2005, the National Credit Act was enacted. So what they're referring to is that's when they had the idea, like this light bulb moment. Guys, we need to regulate the credit industry. Let's take a piece of paper. Let's write down some ideas of what we need to change to make this credit industry function better. Okay, so that's the enactment date. But then the commencement date, now it's no longer an idea. Now it's an actual piece of legislation. Now we have to start following the rules. So the difference between the two is the first date, the enactment date, was where they only had an idea to better manage the credit industry, but the commencement date was where we actually had to start following the rules. So from 9 May 2006, the rules were applied and we had to follow them. Okay. So this is what I refer to when I mentioned blue. Okay, so everywhere where you see blue highlighted on the screen, that's what you highlight in the book. The book is in the same order as my slides, so it should be easy to locate all of the different parts. But this is, I've worked through one of the exams. I'm not allowed to work through all of them. There are 5. But this is just questions that they refer to often. Okay, so they do distinguish between the main purpose and the main objective. So the main purpose of the National Credit Act is firstly to create a secure credit marketplace that is fair and non-discriminatory against consumers. But they do mention that another purpose is to minimize reckless lending. What do you guys understand under reckless lending? Anyone?
I was also a victim of reckless lending.
Okay, so what do you feel?
Yes, after I was out of school, I finished my matric, then I got offers from Home Choice, offers from Edgar's and stuff. So I took about everything. Then after 5 or 6 months or so, I couldn't pay.
Exactly.
Yes.
Okay, so guys, have you heard about Oprah? I feel almost everyone knows Oprah, right? Okay, so if you've seen at least one Oprah show, you would have seen that always during her show, she's like, everybody's getting one, and then you're getting something and whatever, and it's look under your chair. Well, this is the way I want you to remember reckless lending. So that's basically where they say everybody's getting credit, you're getting credit, but they don't actually check whether the consumer can afford the credit. And that is the reckless part. Okay, so the textbook definition of reckless credit is lending without regard of the borrower's ability to repay, which will then result in over-indebtedness. Okay, so exactly like Thembiso just said is they gave him credit, but they never checked whether he can actually afford it. And a few months down the line, he's unable to actually repay it. And now he's over-indebted. Edgar's is actually a wonderful example because I know when I started out, also when I was out of school, now you have to get credit against your name, but no one's willing to grant credit because you don't have references. Except Edgar's, they're always so willing to grant credit. And look what's happening now to Edgar's. They are actually closing down shops because they don't have the funds available anymore because they granted credit to people and now they aren't repaying the credit and now they need to close their doors. Okay, so that's a good example. Okay, so reckless lending, we think about Oprah just giving credit to everyone without considering if they can actually afford the credit. So that's the main purpose of the National Credit Act. Now we move on to the main objective of the National Credit Act. And the first thing they say is to ensure that credit granting is transparent. What is transparency, guys? Silly example, but can you see behind this bottle? Yes. Can you see behind a window? Yes. It's see-through. So basically, they want to make sure the entire credit granting process, nothing is hidden away. We cannot hide any details from the consumer. We cannot try to hide, certain products that we add or hide the interest that we charge or whatever. So the objective, one of the main objectives of the National Credit Act is to make sure every single detail is disclosed. Okay, that's objective 1. Objective 2 says to ensure that all eligible consumers have the right to apply for credit. Okay. Guys, if everyone has the right to apply, does that mean that they will be approved? No. Okay. So anyone can apply, but the determining factor on whether you will be approved will be based on your specific credit profile. Can you afford it? What is the risk that you pose to the company that's offering the credit? Okay. So tomorrow, they ask you in one of the questions, identify the main objectives of the National Credit Act. And the first one you easily identify. You can easily see to ensure that credit granting is transparent. But now the next one, they change one word because you guys need to keep in mind the National Credit Act is a piece of legislation. That's the law, that's it, no funny business. So they can't try and trick you. So the only way that they make the questions a bit more difficult is in the way they ask the questions or the way they pose the answers just by changing one single word. Okay, so tomorrow they say the main objectives and they give you one option that says to ensure that credit granting is transparent. But the second option, they say to ensure that all eligible consumers can obtain credit. What does obtain mean? Obtain means to get it, right? So that's not true because not everyone applying will get it. So don't let the way that they pose the answer confuse you. Everyone can apply, but not everyone will be approved or not everyone will obtain it or not everyone will get it. Okay, different words coming to the same conclusion. While I'm on that topic, I just want to show you guys something. So in tomorrow's exam, this is not applicable for the mock exam, but this is applicable for the actual exam, okay? So in tomorrow's exam, some questions tell you to pick more than one answer, but other questions, they don't ask you to pick more than one, but more than one answer is actually correct. And if you don't pick all of the correct ones, you obviously lose out on marks. So I've noticed, or I found the trick or basically the trick behind it. Can you guys see on this? It's very light, but if they give you a question and there where you're supposed to select the answer, if it's a circle where you need to select, it wants you to pick one answer. But if they give you a question and there where you're supposed to select the answer, it's a square, then you are supposed to pick more than one answer. So circle, only one answer is correct. Square, more than one answer. That's a cheat sheet. Please remember it because it will make sure you don't lose out on marks tomorrow. Okay. Something silly, but this can literally, guys, I had someone in the beginning of the month and they got 69%, 69 point something. Okay. And the only reason they did not pass is because they did not pick where it wants them to pick more than one answer, they didn't do that. So it's not even that they had questions wrong, they just missed out on marks because they didn't read it properly. So there's something like this where you see a square, you have to pick more than one answer. You pick all of the correct answers, okay? You cannot pick all four of them because obviously that will not help at all, but please make sure you make a note of that. Okay, so then the National Credit Act also strives to create a more regulated credit environment for consumers as well as consumers' information. So if they say they want a regulated credit environment for consumers and the information, there's one piece of legislation that usually comes to mind for most South Africans nowadays, and that's the POPI Act. You guys, everyone uses that as an excuse. If someone phones you from a telemarketing company and you just say, do you know the POPI Act? You're not allowed to contact me without my consent, etc. Okay, so what they're trying to say is that in the past, consumers and their information were shared freely. But now with the NCA in place, the information of that consumers only allowed to be shared with the relevant parties that need to determine whether this person will be approved for credit and no one else. Okay. Then the National Credit Act is applicable to all credit providers in our country. So if you grant credit, you are supposed to be registered as a credit provider, and then, of course, you have to adhere to the rules of the National Credit Act. Okay. When the NCA commenced, so when it became effective, it actually replaced two pieces of legislation, which is the Usury Act of 1968, as well as the Credit Agreements Act of 1980. Now, they don't usually ask this just because they feel it's almost too easy. But if they ask the two pieces of legislation that was replaced by the NCA, they will pose this as straightforward as possible. They will not require you to remember the year. They'll only say, which two pieces of legislation was replaced by the NCA? The Consumer Protection Act, the Credit Granting Scheme, the Usury Act, or the Credit Agreements Act. And you just have to identify the correct names, okay? So don't take hours just trying to remember the years. As long as you remember the name, you will be okay. Cool. So earlier on, I asked you guys what happened before the NCA. Thembiso said that consumers were granted credit, but they cannot actually afford it, and it resulted in over-indebtedness, right? So consumers were not sufficiently protected from microlenders, and then the microlenders charged them unreasonably high interest rates. And then they found themselves in a world where it basically gets impossible for them to pay off all of their debt. So they had to make a loan to survive. And guys, this is like a snowball effect. Can you imagine? At the end of the month, they have all of these bills to pay, and they think, okay, I'm going to take out a loan to cover my expenses. But now, at the end of next month, you still have the same expenses and the added loan. And then some people say, okay, but I'm just taking out another loan to pay off my current loan. And before they realized that it was literally a snowball effect where it got bigger and bigger and out of control, and they had no way to pay back their loans. Okay, so this is what the NCA is trying to prevent. That if they can see clearly, oh, but this consumer cannot afford any more credit, then they won't be allowed or approved for more credit. Okay, cool. So now we look at, let me just go back. Now we look at the purpose and application of the National Credit Act. So the National Credit Act is actually enforced by the National Credit Regulator. So a lot of times throughout the book, we have a lot of acronyms, you know, NCA, NCR, NCT, DTIC, and it gets overwhelming. So I want you guys to make a note on a cheat sheet on how to remember it, okay? So the NCA, guys, that's the law, because it is actually the law that's governing the credit industry, okay? So NCA equals law. And then if it's enforced by the National Credit Regulator, it means that the NCR is the policeman. Okay, because they make sure we follow the rules of the law. So it's easy to remember. If NTA is the law, the NCR is the policeman. Okay. So now let's start with the first purpose. The purpose of the NTA is to educate consumers, to make consumers aware of their rights so they know when they are being taken advantage of. Okay. But the next one says it's also to establish the National Consumer Tribunal. Oh heavens, another acronym, the NCT. Where do they fit in? Okay. So let me give you this scenario. I'm Absa. Okay. I'm the bank. I extend credit to Tian. Okay. So he's the consumer. In the process, okay, I take advantage of the consumer. Maybe I charge them unreasonably high rates, or I grant credit and they cannot afford it, whatever the scenario might be. I broke the law, so I broke the NCA, the law, okay? Now it's reported to the NCR, the policeman. And if the policeman investigates and they find out that the allegations or the acts that I'm being accused of is actually true, then they will report it to the NCT, the National Consumer Tribunal, because the tribunal can be considered a court or a judge because they have the same ruling authority as the High Court. And they basically decide what happens with guilty parties that breaks the law of the credit industry. You see the process. So NTA is the law. The NCR is the policeman, making sure we follow the rules. And if someone breaks the rules, they investigate and they report to the NTT because the court needs to decide what happens to the guilty parties. Everyone good with that? Okay, cool. Sorry, I just need to take a quick sip of water. I'm doing all the talking now. Okay. So the next purpose is to simplify and standardize the way that information is disclosed on credit agreements. Have you guys entered any credit agreements ever? Not yet? Okay. You have? Okay. I'm guessing we are the older party if we did. If you haven't yet, Tiana, I'm assuming you're still young, and that's maybe right. Okay, cool. So what they're trying to say is that basically we want a template, right? Whether you are entering a credit agreement with Absa or with Standard Bank or with Nedbank or whoever, the template, the general information required should remain the same. Of course, the minor details will change. For instance, the details of the consumer or whatever the asset is they're getting on credit, that minor details will change. But in general, they want to make sure the same information is disclosed to the consumer. For instance, every single credit agreement will include terms and conditions. Every single credit agreement will include the term of the agreement, the interest rate the consumer was approved for, the deposit required from the consumer, etc. So they want to say that even though minor details may change, in general, they want to simplify and standardize the way that the credit agreements are set up. Okay. Then the next one, to promote and advance the social and economic welfare of all South Africans. I used to ask this as a question, and it took like 10 minutes for everyone just to decide on an answer. So now I just go straight to the answering point. Okay. So in this scenario, they try to prove to you what ripple effect it has if the NCA is applied correctly, how it can affect the different areas of our country. Okay, so hear me out. If it says promote and advance the social welfare of our country, so they're saying that if, let's give you an example of Mr. John. Okay, Mr. John, we have a friend. Okay, so Mr. John is, for instance, over indebted. Mr. John cannot pay all of his bills, but he still has family and kids to take care of. So now they say that he's over indebted, he doesn't know how to pay his bills, and he still needs to provide for his family. So sometimes he maybe steals food just to make sure his kids have food on the table. So they say that now the crime rates go up because this person is not in a healthy financial situation. So they say, do you see the ripple effect that if the NCA is applied correctly, credit is only granted to people who can afford it, it will have a positive impact on the crime rates of our country. Okay, or if they look at the economic welfare, let's take Mr. John again. Now, John actually can afford the credit that he applied for. So at the end of the month, he pays all of his bills, he pays the credit, but he still has money left. And because he's in a financial situation where he has money left, he decides to invest that money. By investing it, it has a direct impact on our economy because now our economy is growing because people are actually putting back into our country. So once again, they say if people are in a better financial situation, it will have a direct impact on our economy as well. So they're trying to show that in each scenario, if the National Credit Act is applied correctly, the outcome will reach far more than just the credit industry because it will have a big effect on other aspects of our country as well. Okay. Then the next one, it says to assist over-indebted consumers to restrict their access to new debt. Okay, so this person's already over-indebted. And the image I want you guys, just hear me out. I'm not saying if you are over-indebted, you are a criminal. I'm trying to make sure you are remembering the words that I'm telling you, okay? So what they say in this scenario, and what I want you guys to remember, think about someone that just got out of jail, okay? Once they are released, they need to report to a parole officer because this parole officer will do anything in their power to make sure that this specific convict doesn't do anything to go back to jail. Okay, so we're thinking about that. Now we look at the debt part. If someone is over indebted, then the debt counselor will do anything in their power to make sure that the over indebted consumer doesn't get any more access to new debt up until their current debts are paid off. Does that make sense? That's why if you've ever had known someone who's undergoing debt review, then once you are undergoing debt review, that is noted at all the banks. Okay, so basically, should you try to apply for new credit whilst undergoing debt review, you will be declined up until you are debt free. Okay, cool. The next one, guys, is quite a mouthful, and I do not expect you to remember it. So the next one, this is the ideal marketplace. This means that if everyone did what they were supposed to do, everything in the national credit or everything in the credit industry functioned perfectly, then it will promote a fair, non-discriminatory, controlled, competent, sustainable, responsible, efficient, and accessible marketplace. So do you hear it's a mouthful? This is what we are trying to achieve. We want to make sure that if we do everything correctly, this will be the outcome for the credit industry. Okay. And then to ensure that all credit products are handled in the same way by different providers. So in this scenario, they're saying, let's say Tian goes to Absa today and applies for a credit card. And he goes to Standard Bank later today and applies for a credit card. They want to make sure that the process followed is exactly the same. I'm not referring to, Absa gives you coffee, but Standard Bank doesn't. That's not what they're referring to, okay? Specifically related to the credit agreement. That means that if you apply, they require the same documents. They want the bank statements and the pay slips. Then they have to do the background check to see what is the credit you currently have against your name. can you afford more credit? So they do an affordability assessment. If you are then approved, then they draw up a pre-agreement statement and quote, because they want to give Tiaan the opportunity to properly work through the documents to decide whether this offer is in their best interest. And only then a credit agreement is signed with the same template, T's and C's, everything. The only details that change will be from one consumer to another. But what they're trying to say is that the process for a credit application must be handled the same way, even if it's a different credit provider. Okay. Then to regulate the credit bureau and information that they keep on record about consumers. Guys, what's a credit bureau? Anyone? Tiaan, would you like to try this one? You're going to look for it in your book. No, I want you just to, even if you just guess, I don't care if it's wrong. I just want you to guess. What do you think a credit bureau will be?
The credit bureau just investigates all applications and reports regarding credit.
That's perfect. You see, so basically we can consider a credit bureau as an institution that keeps record of all outstanding credit. So I almost imagine this big computer, right? And I go and I type in Danel's ID number, and on the screen it picks up, okay, so Danel has a home loan, Danel has a vehicle finance, Danel has a credit card, for instance. So the credit bureau keeps record of every single outstanding credit agreement. So when someone applies for credit, they apply with a credit provider, right? But the credit provider is obligated to check with the credit bureau whether this consumer can actually afford the credit or not. Okay. So not only do they regulate the credit bureau, but they also regulate the information that they keep about consumers. So to see whether the information is true or not. And then the last purpose will be to have a regulator to regulate the entire credit market. And by now, I hope you guys know that this will be the national credit regulator, and they are the policemen. They are making sure we follow the rules. Awesome. Okay, so I'm not going to start on the left hand of this or left side of this slide. On the right side, you guys see at arm's length, okay? And before we read the description of at arm's length, I want you to look at that picture. You see two people shaking hands, right? So do you think this will indicate a professional or a personal relationship? This almost looks like a business transaction, right? They're shaking hands, professional, that's it. So when we think about at arm's length, we think about shaking hands, because the meaning of at arm's length refers to two parties who are independent and on equal footing. If they were hugging or they were kissing, then we might have thought, okay, this is a personal relationship. So what they're trying to say is the National Credit Act will only apply for transactions that are at arm's length. Okay, meaning that without this transaction, there won't be a relationship between the two parties. It's almost like, can you imagine that today you sign a contract with Absa and then tomorrow you go to Absa's house to have a braai? It doesn't work like that, right? So for dealings to be at arm's length, it is only of a professional nature. Okay, so now keeping that in mind, now we look at who does the National Credit Act apply to? So the National Credit Act applies to all credit agreements. It's between the credit provider and the credit consumer, but this is the criteria: ensuring that both parties are treated equally, as long as the dealings are at arm's length. That's the one mark you can highlight. Dealings must be at arm's length, and they are made within or having an effect within South Africa. Of course. So basically they say that for the National Credit Act to apply, it must only be on professional agreements, not personal agreements, and it must be made within our country or having an effect within our country. And that is the reason is this is the National Credit Act of South Africa. So we cannot expect the National Credit Act of South Africa to be applicable in England or in America or wherever, because it's only our National Credit Act. Okay. So now this is the first scenario, and you can expect similar questions in the exam tomorrow. Okay. So let's look at the first one. John and his wife, Lynn, decide it's time to purchase a new vehicle at a cost of 200,000 Rand. So they are not fond of the idea of financing the amount, and now they're asking Lynn's father to borrow them the money. So Lynn's father then agrees to borrow them the money at a low interest rate of 6%, which they will pay back over 42 months. Now they want you to choose the correct statement. Option A says that the National Credit Act will not apply because the interest isn't according to the regulations. Option B says the fact that interest is charged will ensure that the agreement falls under the National Credit Act. Option C says the NCA will not apply because the agreement is between family and therefore not at arm's length. And option D says when money is borrowed, it should fall under the NCA. Which one do you guys pick?
C.
Okay. And you, Timbiso? Also C. Perfect. Because we just mentioned in the slide before that dealings must be at arm's length. And if it's her dad borrowing the money to her, obviously that's a personal relationship. It's not professional. They won't be shaking hands. So therefore, not at arm's length, NCA won't apply. So that's an easy way to remember it. Okay. So now they give us examples of credit agreements that are actually at arm's length, and that will be personal loans, credit card facilities, hire purchase agreements or installment sale agreements. Installment sale agreements example will be when you finance a vehicle, okay? Revolving credit as well as home loans. But most importantly, at the bottom of the page, they do ask you, which two things do credit agreements have in common? And we don't even have to read there. We can just rationalize it, okay? So step one will be where credit is offered or credit is extended, right? But what do they expect in return? Obviously, if they extend the credit, they want repayment along with interest, because that's the only reason they're willing to grant the credit in the first place, is because they make money from the interest that they charge you. So this is the only question in the exam where they will ask you for two things, but both options will be given to you in one sentence. For instance, if the question says, which two things do credit agreements have in common? In option A, for instance, it will say credit is extended and a charge fee or interest is payable. So with this one, don't go looking for two answers because both answers will be in one sentence. Okay, cool. Guys, have you ever heard about a natural person versus a juristic person? Tian, you look a bit confused. You also. Okay, so can you guys see me? Can you hear me? You can talk to me, right? I'm a natural person. I'm an actual human being. There is a person identified as Danelle, and we know that by the fact that I have an ID number. I'm a living, breathing person. That's the one thing that makes me a natural person. But they say a sole proprietor. Okay, do you guys know what a sole proprietor is? Okay. They will also be considered a natural person. Why? Because if the sole proprietor is being liquidated, they will take the personal assets of that sole proprietor. That's why they are considered a natural person, okay? Because they are acting in their own capacity. Now they went and added one extra one. And they say that a trust can also be considered a natural person, but there's a specific criteria. So for a trust to be considered a natural person, it must be a trust with two or less, that's what you highlight, two or less natural person trustees, and where the asset value or the annual turnover is less than 1 million. So in the exam, if you need to identify whether a trust will be considered a natural person or not, the first thing you think about is two or less natural person trustees. And the second thing you think about is the fact that the annual turnover or the asset value is less than 1 million. Okay, so that's a natural person. Now, a juristic person, the easiest way to know this is it's a company. Okay, if you think about Edgar's, can you walk up to one person and say, "Hi, Edgar's, how are you doing?" No, it's a company, right? And that's a juristic person. So if it's a partnership, association, any bodies of persons, whether corporate or unincorporated, doesn't make a difference. But we identify them by the fact that they have a registration number. It's not an actual person, it's a company, a lot of people working for this company, and the company accumulates assets in the company's name. But they can also get credit in the company's name. That's a juristic person. But now, once again, they do have to add another spanner in the works, and they say that a trust can also be a juristic person. But in this scenario, the criteria is different. So with a natural person, remember two or less, and the annual value or asset value is less than 1 million. So for a trust or juristic person, for a trust to be considered a juristic person, it is 3 or more individual trustees, not 2 or less. And the trustee is a juristic person itself. That's your criteria. There's no quick and easy way to remember this. This is just the criteria you have to study. Okay. That's just to distinguish between when a trust will be considered a natural person versus when it will be a juristic person. Okay. So now we move on to the list of exceptions. Okay. So a list of exceptions is all of the following agreements. They do not fall within the rules of the NTA, meaning that the National Credit Act will not apply to these types of agreements. The first one says foreign credit providers. But wait a minute. Do you guys recall when we read who will the act apply to? It says made within or having an effect within South Africa. So if it's a foreign credit provider, it's not in our country. That is why the NCA will not apply. Informal credit agreements between friends and family. Once again, if we go back, it says that the act applies to dealings that are at arm's length. And between friends and family, it is not at arm's length. And therefore, the NCA won't apply. So I think in majority, it's easy to identify why a specific transaction will be excluded from the NCA or won't be covered by the NCA. Okay, so now the list goes on and it says insurance policies, developmental credit agreements, incidental credit agreements. Don't worry too much about these two. We will discuss them in detail later on, okay? School or student loans, emergency loans, and public interest agreements. Directors or shareholders loan to their company. Can you imagine the NCA applies to when someone invests money in their own company? It doesn't make sense. Okay, pawn transactions. You guys ever heard about cash crusaders? I think it's cash. So basically that's where you go and you tell them, I need a loan. They give you the loan, but they want you to give them your TV as collateral. And then only when you pay back the loan will you get your TV back. Okay, so that's a pawn transaction. And it's not covered by the NCA. The three that I highlighted, that's the exceptions that they usually refer to most during the exam. So any organ of state or the state itself, leases on immovable property. So now they're clever. Now, tomorrow in the exam, they say, will the National Credit Act apply to leases on motor vehicles? A motor vehicle is a movable item. You can actually move your motor vehicle, right? So yes, it will apply, but leases on immovable property will not apply. Okay, NTA will not apply to it. Then the temporary increase in the credit limit under a credit facility. A juristic person, so that's a company, with an annual turnover equal to or exceeding the threshold value of 1 million. And this is once again your cheat sheet. The moment that it exceeds 1 million, we know it will be on the list of exceptions. A juristic person with an annual turnover below the threshold. So now you're a bit unsure because it's below the threshold. But this consumer then enters into a large agreement, which will automatically push them over the threshold. And therefore, they are on the list of exceptions. And then the last one, it says a trust with 3 trustees, or where one of the trustees is a juristic person. So far, that's exactly the definition. Let me just go back. So far, we've said exactly the definition there at the bottom of when a trust will be considered a juristic person. But the only thing that changes it is the fact that it says, but now the asset value or the annual turnover once again exceeds 1 million. So once it exceeds, it comes on the list of exceptions. It's not covered by the NTA. Okay. Cool, that's the first chapter done, guys. Any questions so far? No questions. You guys getting 100% tomorrow. That's so good. I'm so impressed. Okay, cool. So now we're moving on to the consumer credit institutions. Have you guys ever seen the logo at the top of the page, that NCR logo? Okay, that's good. Where have you seen it, Mbiso? For some reason, when you switch on the mic, the camera goes off though. It's like, is it the same button? It's so funny. You are muted. Almost there. There we go.
I have seen it on almost every FSP that I have been to. I have seen that the NCR.
Okay,
sticker.
that's perfect because the FSP, right? Whoever grants you the credit, they have to be registered with the National Credit Regulator. And that logo is proof that they are registered. Sorry, I just want to move the camera a bit. So that logo is proof that they are registered. That's proof that they are following the rules of the NTA because they are registered with the National Credit Regulator. Okay, so going back, we said that the National Credit Regulator is the policeman. They make sure we follow the rules of the NTA. So they are responsible for the regulation of the South African credit industry. It is a juristic person. Now we know a juristic person is a company, right? Because we cannot walk up to one person and say, hi, NCR, how are you? Okay, it's a company. We have a bunch of people working for the company. It's overseen by its CEO, so it's managed by one person, okay? And then the National Credit Regulator is independent and subject only to the Constitution and law. Why? Because they want to make sure that the National Credit Regulator remains impartial and transparent. They won't be persuaded to pick certain sides. They know what the law is. They implement the law, and whoever is not acting within the rules, they will be taken care of. Okay. Sounds very hostile. Like, I don't mean they'll be shot or anything. I just mean that action will be taken against them. Okay. And then the NCR is overseen by its CEO. Okay. On this page, I highlighted in blue because they do ask this as a question. So they ask you, the National Credit Regulator is responsible for the registration of credit providers, credit bureau, debt counselors, and payment distribution agents. Okay, what is a credit provider? Easiest way, it's explained in the name. The party that provides credit. What is a credit bureau? Tian mentioned earlier on, that's the institution that checks on all of the outstanding credit noted against your name, because that's how they decide whether you can afford more credit or not. Okay, then a debt counselor. This will be a person that basically advises a consumer who is over indebted onto how to better manage their debts. Okay, and then the last one, have you guys heard of a payment distribution agent? Yes, no. Okay, so this is basically a middleman, guys. What happens? Consumers over indebted. The court orders the consumer to undergo debt counseling. The debt counselor makes a plan and says, okay, this is how we're going to approach your debt. This is how we're going to better manage your debt. Maybe you have 3 accounts and we are going to pay a lump sum of 5,000 Rand to the payment distribution agent. But then the payment distribution agent pays the relevant credit providers according to the plan that they receive from the debt counselor. So they only get the money from the consumer and pay the relevant credit providers according to the plan that the debt counselor gave to them. Okay, so the National Credit Regulator is responsible to register all of these role players. But not only do they register them, they also monitor the conduct of these parties. So if anyone's not acting like they're supposed to, they will take action against them. Okay, cool. This list, guys, will seem vaguely familiar because if we read through the functions of the National Credit Regulator, you will notice that the purpose of the Act now becomes the function of the regulator. So the whole reason why we're implementing the National Credit Act now becomes the daily job of the National Credit Regulator. Okay, so firstly, it's to educate and create awareness of the protection offered by the National Credit Act. It's also to promote the development of an accessible credit market, particularly to previously disadvantaged persons. Then it's to research the credit markets and to monitor access to credit as well as the cost of credit, to identify factors that will influence or undermine access to credit, competitiveness, or consumer protection. It is also to advise the government on policy and legislation and how this will influence the credit market. Then the NCR receives and investigates all complaints. They ensure that consumer rights are protected at all times. They enforce and ensure the full compliance of the National Credit Act, and they will take action against all parties who are not acting within the rules of the National Credit Act. So this is basically the job description of the National Credit Regulator. Okay, let's move on to the next one. So you guys heard about the NCT. We said earlier on that if someone breaks the law, it's reported to the policeman, the NCR, and then the NCR investigates. And if they see, but there's actually truth to the allegations, they will report it to the court, which will be the National Consumer Tribunal. So the National Consumer Tribunal is a juristic person. They are allowed to prosecute on behalf of the National Credit Regulator. They have the same authority as the High Court, and they consist of a chairperson, no less than 10 other people, and all of them are actually appointed by our president. Okay, but the main task, the part in blue, the one I want you to remember for tomorrow is that the National Consumer Tribunal's main task is the adjudication of complaints. So deciding what happens to the people who do not act as they're supposed to according to the NCA. Now, I just want to go back, guys. Do you remember here on this slide where it says that the National Credit Regulator is responsible for the registration of all of these role players? Okay. Tomorrow in the exam, they give you this exact question, but the options they give you is, what is the responsibility of the National Credit Regulator? Option A, the registration of credit providers. Option B, the training of all staff of credit providers. Option C, the appointment of tribunal members. And option D, the registration of debt counselors. Which options are correct?
The 1 and 4.
Exactly. The credit provider and the payment distribution agent. Even though, the debt counselor, sorry. Even though the National Credit Regulator creates awareness or educates consumers, they do not actually train the staff of the credit providers. That will be the responsibility of the credit provider. And what they sometimes confuse you guys with is they do say that the National Credit Regulator is responsible to register the national tribunal members, which is not, because they are appointed by our president. Okay, so don't forget that part. Awesome. So this is a court case. And the reason I include it, firstly, legislation can become boring after a while. Okay, so I want to prove to you what happens if we don't follow the rules of the NCA. So this was a court case between BMW Financial Services. We all know BMW, the nice cars, okay? And they had a court case against Mr. Peter Heidenreich, and it happened in March 2023. So Peter bought a vehicle at BMW Melrose in 2017, and then there was 150,000 Rand cashback added to the transaction because Peter wanted to invest this money. Peter knew at that time that he was actually unable to afford this fancy car, but he thought, you know what? I'll just pay the installment with the interest that I get back from my investment. And I reminded you guys of Murphy's Law earlier on, okay? So this is what happened. The investment did not grow as he anticipated. So he actually lost all of his money, but now he still needs to pay the installment. So then ultimately he decided he's going to surrender the vehicle. That is within your rights. It's in your contract where it states that if you can no longer afford a vehicle, you are allowed to voluntarily surrender the vehicle. So basically what the credit provider does, they place the vehicle up on auction, and the consumer is only liable for the difference between the auction amount and whatever is left on their settlement, whatever they still owe to the credit provider. But in this scenario, the vehicle was sold at a shortfall of 490,000 Rand. And who's responsible for that? Mr. Peter. So now he's refusing to pay this amount. Now all of a sudden he's complaining that the salesperson at the dealership over-declared his income and under-declared his expenses. So he's saying that, oh, he was a victim because they lied on his application. Okay. Afterwards, he tried to say also that reckless lending took place, which I think is actually the case here because he was never supposed to be approved if he cannot afford it. But the mistake he made was by basing the whole court case on the fact that he said that another party lied. The salesperson at the dealership lied, and he was unaware. That was his first mistake. Okay, so what do you think? Do you think Peter won or lost the case? Won or lost? Okay, lost. You, Timiso?
He lost the case.
Okay, perfect. Both of you are correct. He lost the case. I should seriously change this image because this guy does not feel like he's losing at life. So I just need to get another person here. Maybe I'll get that CEO from that scandal. I think he feels like he's losing at life at the moment, hey? Okay, so why? Why did he lose the case? Because the dealership followed the rules, okay? So just by ensuring that the client signed the completed application form, because what happens when you apply for credit? You have to fill out an application. So now you sign that application form. Your signature is an indication of your consent, that you agree with everything noted on that application form. And guys, he did not even sign for it once, he signed for it more than once, because when you sign the contract, it also includes your income and your expenses. So he signed for the same amounts again when he signed the contract. So how can you not be aware if you sign for it more than once? Okay, let's say the scenario was different. Let's say that the application was not signed. Or let's say that maybe the salesperson emailed the application to him, the client signed it, but the rest of the form was blank and he sent back the signed blank form. Then it might have been a different scenario. So what we're trying to say is that when an investigation starts, it always starts at the beginning of the transaction. And the transaction begins usually with you as an agent, whether you're working in the bank, whether you're working at the dealership. Once you embrace this role of an agent on behalf of the National Credit Act, the investigation starts where the transaction started. And in this scenario, the salesperson did everything they were supposed to, and that's why Peter lost the case. Okay, cool. Now we move on to the Department of Trade, Industry and Competition. So they are actually responsible for commercial as well as industrial policy. The DTIC develops and reviews regulatory systems in the areas of competition, consumer protection, company and intellectual property, as well as public interest regulation. So now the DTIC identified a few problems in our credit industry. Firstly, they saw reckless behavior by credit providers. So basically credit providers granting credit to anyone who applied, or credit providers charging unreasonably high interest rates, but also deceptive pricing. Can you guys think of an example of deceptive pricing when it comes to credit? Okay, let me give you an example. So have you seen an ad where they tell you that you can drive the brand new vehicle at the low installment of 999 Rand? But then when you want to go to apply for this, they say, oh, sorry, you don't qualify for it because it has a 50,000 Rand deposit and it has a prime rate calculation or whatever the scenario is. So they say in the past, credit providers tried to trick consumers with deceptive pricing by not disclosing on how they got to that specific credit installment. Nowadays, if they want to sell a credit installment, whether it's for a credit card or whether it's for a loan or whatever the scenario is, they are obligated to disclose the calculation they used to get to that installment. So they have to show you what is the rate they calculated on, if there's a deposit they calculated on, for how long this agreement, or what is the term for this agreement, etc. Now you'll see that most of the ads includes the calculation, but it's like in the finest print you've ever seen, just because they are adhering to the rules by disclosing it, but they try to make sure that you can't see it. Okay. So also another problem that they identified in our credit market was lending without regard for a borrower's ability to repay, resulting in over-indebtedness. So that's reckless lending, right? We've mentioned this a few times by now. But also the exploitation of consumers by microlenders, debt administrators, and debt collectors. The chasing of small balances from clients, sometimes even resulting to abusive collection techniques. That's why I gave you the image on the right side of the page. They refer to loan shark. Guys, if it's too good to be true, it probably is. Where they say, you know what, we'll just grant you the credit. They do not follow any of the processes. And it's all fine and dandy up until you miss the first payment. Then you either lose a limb or you lose your life, okay? Because they want to get back what they borrowed to you. And that's what the DTIC is trying to prevent. They're trying to identify loan sharks, to make consumers aware of loan sharks, and to give consumers the opportunity to know when they are being taken advantage of before they enter into these agreements. So now the DTIC strives to create two things. They want to create employment and equity, as well as a vibrant economy. So employment and equity will be built on the full potential of all citizens. And that can only be characterized, built on full potential of all citizens. So what they're referring to here is that if everyone was employed, everyone can pay their bills, it will have a positive impact on our credit industry as well. And then with a vibrant economy, that can only be characterized by growth. Once again, if everyone's in a healthy financial situation, they are able to pay their bills, but they even have money left to invest, it will have a positive impact on our economy. Okay. So without even looking at this page, if you just have to go at the top of your head, what is a credit provider? We did it earlier on as well. The word explains it.
Someone who provides credit.
Exactly. So the textbook version says the party that supplies goods or services under either a discount transaction, incidental agreement, or installment sale agreement. It can be the lessor under a lease or any other person who acquired the rights of a credit provider under a credit agreement after it had been entered. You remember that the National Credit Regulator is responsible to register a credit provider. In blue, I mentioned to you that it is mandatory to be registered with the National Credit Regulator before providing credit. Guys, tomorrow they will give you a scenario where they will say, ABC Limited is in the process of registering as a credit provider. But to get the business going, they started granting credit already. Will these agreements be binding? And you have to look for the answer that says no, because loans granted by an unregistered credit provider will be unlawful. And actually, the consumer has no obligation to pay back the money that they got from the credit provider, because the credit provider was never allowed to grant the credit in the first place. If you are not a registered credit provider, you cannot act as a credit provider up until you are registered. Okay. So don't let them try to convince you tomorrow in the exam by saying that they are busy getting their registration in order, but in the meantime, they've already granted credit. It will not be allowed up until they are fully registered. Okay. And you will hear with every role player that we work through, credit provider, credit bureau, debt counselor, payment distribution agent, with each of them, the one requirement is they have to be registered before they start conducting business. Okay. Then what is the responsibility when you are registered as a credit provider? Firstly, they have to display their registration certificate in a durable manner. Do you remember I showed you that NCR logo and you guys said that you saw it at FSPs or wherever? That's their way of proving that they are registered to act as a credit provider in the national credit industry. Okay. But also they have to show their registered status on all agreements and documentation. So even if you have like a Woolworths account, next time that you purchase on your account, you just take a look at the slip. And at the bottom, it will say that Woolworths Pty Limited is a registered credit provider, because that's once again how they prove to the consumer that they were allowed to offer goods on credit. And then the last one, it is the job of a credit provider to conduct an affordability assessment. That's why when you want to open an account with a credit provider, or you want to take out a loan, or you want to apply for a credit card, they will always ask for your payslips, your bank statements, and an application form. They will submit these documents to the credit bureau. The credit bureau will do all of the necessary checks in the background to see whether you approve for this credit that you are applying for. And it's a job of the credit provider to do this assessment before they say, okay, yes, we are willing to grant you credit. Okay, because if they decide to grant the credit knowing that the consumer cannot afford it, it's considered reckless lending, and the credit provider is guilty of it. Okay, and the consumer will be a victim of reckless lending, in which case, with reckless lending, the court orders the agreement to be set aside or suspended because they were basically taken advantage of. Okay, awesome. Now, this is where you come in. This is why you guys are doing the training, because you ultimately want to act as an agent for the credit industry. Okay, so an agent is mandated to act or to represent the credit provider. But this does not necessarily mean you are employed by the credit provider. You can sometimes only act as an agent. Let me give you a scenario. Do you guys know what an F&I is? A finance and insurance manager. They work in the dealerships. They sign the contract for vehicle finance with the consumer. Okay. So when they sign the contracts for the banks, they are not employed by Absa, Standard Bank, or Westbank, or anything like that. They still work for the dealership, but because they are a qualified agent, they are allowed to act on behalf of the bank. So I'm just trying to make sure you understand that just because you're acting as an agent, it doesn't necessarily mean that you work for that specific credit provider. Sometimes you are only acting as an agent on behalf of that credit provider. Like, for instance, when you are working as an F&I, you work for the dealership, but you sign contracts on behalf of the banks. Does that make sense? Awesome. So now the person that appointed the agent will be called a principal. And this can either be the bank or the respective credit providers. The most important part, and the part I want you guys to focus on here, is the blue part, and this counts 2 marks in your exam, okay? And that is where they say that an agent can enter into a binding agreement on behalf of the principal. That's the first one. Let's use the example of the finance and insurance manager at the dealership. When they sign the contract, they are entering into a binding agreement on behalf of the credit provider, right? Because you don't see someone from Absa coming in to sign the contract, or someone from Standard Bank. So when the F&I, the finance and insurance manager, signs the contract with the consumer, they are entering into a binding agreement on behalf of the bank. And they can even create liability for the bank, or for the credit provider, or for the principal if they cause any harm while carrying out their duties. What they're referring to here is the finance and insurance manager signs the contract. Afterwards, they get paid for the transaction and they are done. But now the liability lies with the credit provider to make sure that they still get their money back from the consumer, right? The credit that they extended. So they say that if in the process the agent causes any harm while carrying out their duties, that liability will remain with the credit provider, because they are the only party that still needs to recover the money that they borrowed to the consumer. Do you guys understand that part? You sure? Okay, that's 2 marks. Okay, so they will ask you which of the following is applicable to the agent, and the fact that they can enter into the agreement on behalf of the principal, and also that they can create liability. That's your 2 marks there. Okay, so now the agent has the following tasks, okay? So firstly, it's the job of the agent to assess the affordability of the consumer. So that's why when the agent meets the consumer, they will ask the consumer to please give them an application form, to give them the bank statements, to give them the pay slips and all of the required documents so that they can submit it to the credit providers to check whether this consumer can afford the credit. Then it's the job of the agent to draw up a pre-agreement quote and statement for the consumer. So basically, they want to give the consumer an opportunity to read through the figures, to know exactly what they are signing for before they sign the actual contract, because they have to decide whether this specific offer is in their best interest. Then in blue, it says that the agent must display their appointment as an agent. So when you pass tomorrow, we're not saying if, we say when, okay? When you guys pass tomorrow, you will get an NTA card from RLP Training, as well as a certificate from the Institute of Bankers. So the moment that you start working as an agent in the credit industry, this is your proof that you are now appointed as an agent, okay? But also it's the job of the agent to disclose commission and other fees to the consumer. They are not referring to commission that if you, for instance, a salesperson, they're not referring to the commission that you made from the deal, the GP that you made. They are referring to commission related specifically to the credit agreement. And that's commission that the credit provider paid to you to basically thank you for the business that you gave to them. Okay. In the motor industry, they refer to DIC. So this will be DIC. So in your contract, it states that an incentive was paid to the dealer to say thank you for picking Absa, for instance, instead of Standard Bank, to sign this contract with. Okay. Then they must supply a VAT invoice for dealer incentive commissions that will be part of the contract documents that you get from the credit provider. Also, an agent must display the license or the registration certificate of the credit provider. So in this scenario, they are referring to that wherever the transaction is signed, wherever this credit agreement is entered, there must be proof that this agent works with registered credit providers. So they'll have maybe in the background a registration certificate from Absa, from Standard Bank, from First National Bank, or whatever the banks are, to prove that the banks that they are working with or the credit providers they are working with are registered with a national credit regulator. Okay, and then they need to implement an acknowledgement of delivery of goods. So this is, for instance, if once again you are financing a vehicle, they will ask the consumer to sign a delivery note as proof that they took delivery of that item. But most importantly, it's the job of the agent to ensure that all the documents are signed and explained to the consumer. Remember, guys, let's be honest, I cannot remember what I ate yesterday, okay? So how can you expect to remember a client that you signed an agreement with 6 months ago? So the only saving grace that you have, the only proof that you have to protect you if something goes wrong during the transaction is the fact that you have the signed documents from the consumer. Because the signature of all of the consumers or of the consumer on all of the documents is your proof that they consented to this specific agreement. Okay, cool. Now we discussed the payment distribution agent, and I mentioned to you guys that this is the middleman, right? I said that this is a person that distributes payments on behalf of consumers to the relevant credit providers. This is either due to a debt rearrangement, a court order, or even an order from the tribunal or any other agreement. But once again, a payment distribution agent must be registered by the National Credit Regulator. Do you remember it was on the list of responsibilities? They register the credit provider, credit bureau, PDA, and debt counselor. Okay, so what happens, the payment distribution agent must deposit money received into a separate trust account, and then they have to distribute the payment to the relevant credit providers according to the plan that they got from the debt counselor, and they only have 5 days from the day that they receive the money from the consumer to distribute the money to the relevant credit provider. That's it. They don't have a lot of rules about a PDA. They do ask to register as a PDA. You have to satisfy the qualifications, the experience, the competency and honesty and integrity requirements. They do mention that no credit provider may have a direct or indirect interest in the management of a PDA. And this is, of course, to prevent any possible conflict of interest. They do say that all payment distribution agents before the National Credit Act amendment must comply with the new requirement within 12 months' time. And then lastly, all payment distribution agents must comply with the reporting requirement to consumers, credit providers, debt counselors, as well as the National Credit Regulator. I think by now, if I ask you guys the definition of a credit bureau, you will be able to just say it up quickly, right? If you're happy with a credit bureau now, credit bureau is the institution that keeps record of a consumer's credit activities. So just think about when you apply for credit, they type in your ID number. This is what the credit bureau does. And they check all of your credit activities that you currently have against your name. Examples, maybe you heard of some of them, I highly doubt it, but some of the credit bureaus out there will be Experian and TransUnion, but maybe you guys heard of ClearScore because they are well known. Have you heard of ClearScore? It's usually when you log into your Gmail account, you get an email from check your ClearScore now, and then they give you a credit report, okay? So ClearScore is also an example of a credit bureau. The moment that they keep record of credit activities, they must be registered as a credit bureau. And the credit bureau decides whether a consumer can afford more credit or not. So, when receiving reports of or investigating credit applications, credit agreements, payment history and patterns, or consumer credit information, they must register as a credit bureau. If they are compiling and maintaining data reports related to the client's credit activities, they must register. If they are issuing reports concerning consumers or other natural persons based on information or data, once again, they must register. So basically, no person may offer or conduct business as a credit bureau if they are not registered. Okay, so now they ask you, who can be a credit bureau? So if it's already an existing credit bureau before the National Credit Act, they can continue business as a credit bureau as long as they meet the requirements set out by the National Credit Act. And then, of course, any new company that meets the requirements of the NCA will be allowed to register as a credit bureau. But who cannot be a credit bureau? If it's a natural person, they won't be allowed to register. And then also a credit provider. Guys, can you think about it? Can you think that the person who wants to extend the credit is the same person who should check whether you can afford the credit? Don't you think it will cause a conflict of interest? What do you think will happen on month end if they haven't met their targets? They'll just say, you know what? We don't care. Just approve a few people just to make sure we make our targets, okay? So that's why if you are a credit provider, you won't be allowed to register as a credit bureau as well. And then in blue at the bottom of the page, so once again, guaranteed question. They say that consumers have the right to one free credit report from a credit bureau once a year. So basically one free report once a year. So now tomorrow in the exam, they ask you, how often can a consumer get a free credit report from a credit bureau? Option A, every semester. Option B, quarterly. Or option C, every year on their birthday. Which one's correct?
C.
I
Yes.
think it's every year on the birthday.
Yeah, so once what I'm trying to prove to you here, don't let the way that they pose the answer confuse you, because even though the answer didn't directly say once a year, how often do you have a birthday? Hopefully just once a year, right? Okay, so even if the questions or the answer still says every year in January, if that's the only answer that refers to once a year, because only once a year in January, always pick the one that refers to once a year. Okay. They try to confuse you. This is the last two topics, guys. So we only have debt counselor and the National Credit Register left. Then we are taking a break. Okay, so last bit of focus and then we can take a break. So a debt counselor. A debt counselor is a natural person. Once again, they must be registered and regulated by the National Credit Regulator. But in blue, and they do ask this, but only the first mark is in your book. The second one is not. So if you quickly want to write it down or you want to take a picture of it, the second one is not available exactly like that. Okay, so when they ask you tomorrow for the main purpose or the main function of a debt counselor, the first thing is that they assist consumers who are over indebted or who fear they might become over indebted. That's this first one, and that's available in your book. But the second one, another main function of a debt counselor, is to advise the tribunal on the possibility that an agreement may be unlawful. Okay, so who cannot register as a debt counselor? If you are underage, if you are a minor, younger than 18, you won't be allowed to register as a debt counselor. But also, if you are subject to an administration order or debt rearrangement. So basically what they're saying, if you are undergoing debt counseling yourself, you won't be allowed to register as a debt counselor, because in this scenario, experience is not a good thing. Okay, so they want someone who's never been over indebted to advise other consumers on how to better manage their debt. Okay, and then a person employed or engaged in debt collecting or the operation of a credit bureau or any other area that will possibly cause a conflict of interest will not be allowed to register as a debt counselor. So, what is the role or the job description of a debt counselor? I want you to highlight the fact that a debt counselor acts in an advisory capacity. They do not have enforcement power. They do not have authority. So what they're trying to say is you can only tell someone on how to better manage their debt if you are a debt counselor. But you cannot say, I am forcing you to undergo debt counseling. They don't have that authority to do that. Only the court or the tribunal or the National Credit Regulator, only they can force someone and say, I'm ordering you to undergo debt counseling. But the debt counselor can only say, okay, this is how I advise you on how to better manage your debt. Okay, so this is what happens. The debt counselor processes applications of debt review of consumers who are over indebted already or who fear they might become over indebted. But then they are bound by the National Credit Act to investigate whether an over-indebted consumer was actually a victim of reckless lending. So if they can see that the credit provider who granted this credit to the consumer did that recklessly, they'll report it to the NCR, because the NCR then needs to take action against this credit provider because they are not acting like they are supposed to, not within the rules of the National Credit Act. Okay. But now the National Credit Regulator, the tribunal or the court, they are the only parties who can actually force or refer an over-indebted consumer to a debt counselor. So they can actually say, I am telling you, you have to undergo debt counseling to better manage your debt, where the debt counselor can only advise you on how to do it. And then some consumers can actually voluntarily approach a debt counselor. So this is not you waking up this morning and just deciding you don't want to pay your debt. If you voluntarily approach a debt counselor, they will still investigate to see whether it is true. Are you over indebted, or are there any indications that you might become over indebted in the near future before allowing you to voluntarily undergo debt counseling? Okay. And then the last thing is that a debt counselor cannot receive or distribute money on behalf of a consumer. Who is the party that receives the money and pays it over to the credit provider? Who's that? The middleman. What's the name of the middleman? Come on, guys.
Payment distribution agent.
Perfect. That's the middleman. They only get the money from the consumer and pays it over to the relevant credit providers. Okay. This is the last topic before we take a break. Raise of hands. Have you ever heard of the National Credit Register? Just yes or no. You heard it. Oh, okay. Okay, cool. So, guys, what happens sometimes? We have different credit bureaus, right? And we know the job of the credit bureau is to check whether a consumer can afford more credit or not. But now what happens? We have Credit Bureau A and Credit Bureau B. And Credit Bureau A updates their system before Credit Bureau B does. So now consumers are maybe declined when Credit Bureau A checks if they can afford more credit. But when Credit Bureau B checks, they have not updated the system yet, and now it looks like this consumer can still afford more credit. And then sometimes credit is approved for someone who cannot actually afford it just because the Credit Bureau have not updated the system yet. So this is a problem in the credit industry, and they're trying to avoid this problem by implementing the National Credit Register. So the National Credit Register will then keep record of every single outstanding credit agreement. So regardless if you then work through Credit Bureau A or Credit Bureau B, they force all credit bureaus to check the National Credit Register before deciding if someone will approve for credit or not. Does that make sense? Okay. So basically, the National Credit Register will be a single register of all outstanding credit agreements. The reason I put that part in blue, they try to confuse you. Tomorrow, they say that the National Credit Register keeps record of only adverse credit, or the National Credit Register only keeps record of poor payment history, which is not true. It's not just poor payment or adverse credit records. It actually keeps record of every single credit agreement between a credit provider and a consumer, regardless if they are a good payer or not. If you have a credit agreement against your name, it will be noted on the National Credit Register. Okay. And once again, the only reason or the purpose of this is because different credit bureaus update their system at different times. This register is not effective yet, but the National Credit Regulator is working hard to implement this to avoid scenarios where people are approved when they are not supposed to. So if you want to take a picture of that part at the top that says not only adverse credit records or not only poor payment, but every single outstanding agreement, you're more than welcome, because it's not summarized like that in your book. Just to keep in mind that every single agreement will be noted, regardless if it's poor payment or not. If there's an outstanding credit agreement, it will be noted on the National Credit Register. Okay, so what information will they need on this register? So all credit providers will then report either directly to the National Credit Register or they will report to the Credit Bureau, but they want the following information. So they will ask, who is the credit provider, the name of the credit provider, the principal address, and the registration number of the credit provider. They'll also ask for the name and the address of the consumer, the ID number if it's a natural person. If it's a non-SA citizen, they'll ask for the passport number of the consumer, or if it's a company, they will ask for the registration number of the company as part of the information that they need to report on the National Credit Register. And along with that, they also ask for the following, and this is in blue. Okay, so they do ask this tomorrow. They will ask the principal debt. So what was the amount that the consumer financed? What is the amount and schedule of each payment? So maybe the consumer will pay 7,200 Rand over the next 72 months. On which date will this obligation end? And then any particulars of any previous or existing credit that was terminated or satisfied in connection with the making of new credit. So what they're saying, let's say, for instance, you apply for vehicle finance, but on the agreement, it states that you are only approved for the new vehicle if you settle your old vehicle. That's the requirement, a conditional approval, right? So in this scenario, they say that if that was the case, if some of your credit was settled in order to make the new credit, then they want proof of that settlement. So they'll ask you for the proof of payment and the settlement letter to remove the old credit from your name before adding the new credit. Because if both are on your name, it might look like you are over indebted, even though you settled the one to get approved for the new one. Does that make sense? Awesome. Okay, guys. Finally, time for a break. Let me quickly check. It is 5 to 11. Okay, can we be back at 11:15? That's 20 minutes to quickly do what you need to do. Awesome. I'll see you soon. Okay, I am back. It seems that we're just waiting for Timbiso to add again or join again. So let's just give him a minute. Okay. I think we should just go ahead and continue because I don't want to delay your day as well. And then he can just watch the video to recap on whatever I discussed whilst he was away. Okay, cool. Just to make sure, can you still see my screen? Okay, and it's still on module 3. I just want sometimes and it's moving on your side as well. Can you see the new part or not yet?
No, I see the IOB SA screen.
Okay. That happens always after a break, so that's why I wanted to make sure. Okay, cool. Let me go back and say share. Okay. And now when I move, can you see the credit agreement? Awesome. Okay, so module 3, we will discuss credit agreement. So firstly, we look at what will be considered a credit agreement under the National Credit Act. We'll also look at the different types of agreements. So we have agreements with 3 specific thresholds when it will be considered a small, medium, or large agreement. We have some of the agreements which is excluded from the NCA or the rules of the NCA. And then we end this chapter specifically to when agreements are unlawful, meaning the entire agreement will be not binding, or where it has unlawful provision. So the distinction between the two is the one says that the entire agreement won't be binding, where with an unlawful provision, it refers to the fact that a small part of the agreement is unlawful. So either they will amend that part or completely remove that part, but the consumer will still be bound by this agreement. Okay, it doesn't just fall away. Awesome. So I think it's also easy to basically summarize that a credit agreement will be the agreement between the credit provider and the consumer where they either supply goods or services or lends money to this consumer. That's basically your document, just giving you the layout of what we agreed upon for this credit transaction. But now the consumer has the obligation to pay for these goods or services or even repays the money that they borrowed from the credit provider. And that's sometimes in installments, or sometimes it is one single future dated payment in which they have to repay. But the important part comes where the consumer does not only repay the original amount that they borrowed, they also pay interest and additional fees to the original goods, because that's the whole reason that the credit provider is willing to obviously grant this credit, because they will make money from the interest that they charge. Okay. So on this slide with the types of credit agreements, we have 3 thresholds. And to be quite honest with you, if you look at the screen and you only remember the blue part, you will be able to answer these 3 questions. Because in the exam, they don't give you the sentences in terms of, you know, a pawn transaction, a credit facility, etc. They only ask you, under the National Credit Act, what will be considered a small type of agreement? And as long as you can identify at or below 15,000, you will be able to answer. So usually they give you at or below 10,000, at or below 12,000, at or below 15,000. So you just need to familiarize yourself with the thresholds, okay? The only other thing I need you to focus on in the exam, or in the book, they refer to intermediate or a medium agreement. But now all of a sudden in the exam, they refer to an interim agreement. And then for some reason, we don't know what to answer. It's still the same as the medium agreement. Okay. I see he just joined, so he'll probably be connecting at the moment. Okay, cool. So for small agreement, that's at or below 15,000. Then a medium agreement will be anything from 15 up to 250,000. And then a large agreement will be anything that's more than 250,000 will be considered a large agreement. Okay. Timbizo, are you back?
Yes, I'm back. Sorry.
No worries. So I started recording immediately when we started again. You only missed 1 slide so far, and that's just basically where we said, what is a credit agreement? That's the agreement where the consumer and the credit provider basically say one party gives you something on credit and it's the obligation of the consumer to repay along with interest. That was the first slide. And this one just gives you the different types of agreements, and that's the thresholds. So I told Tian, as long as you can identify the blue items, then you will be able to answer the questions tomorrow, because they only ask you, according to the NCA, what will be considered a small agreement, and you have to know that's at or below 15,000. A medium agreement is anything from 15 up to 250, and a large agreement will be anything more than 250. Okay. Then, guys, this is just an extra notation that I added because this is for 1 mark in the exam tomorrow. They ask you, what is another term for a credit guarantee? And you have to know that a suretyship and a credit guarantee, it's the exact same thing. So if they ask you for another term, it will be suretyship. Okay. I'm telling you this now because in 2 slides, it's going to come up again, and then I'm going to ask you, one of you two, which one it is. Okay. So please keep in mind, a credit guarantee and a suretyship, the exact same thing. Awesome. Okay. So now moving on. We have different types of credit agreements. But do you recall seeing these names before? Incidental credit agreement, developmental credit agreement, public interest agreement. This was actually on the list of exceptions, meaning they do not fall under the rules of the NCA. Okay. So this is the types of agreements, and this is why. Okay. So I'm going to explain it to you. So an incidental agreement, it's not required for a company to register as a credit provider in terms of the National Credit Act if they enter into incidental credit agreements. So basically, this is when an additional fee is charged, when an invoice gets paid after the cutoff date, or where they quote 2 prices, and the lesser will be applicable if they make payment before said date. So basically, I tell you, Tian, I can give this item to you today for 1,000 Rand, but if you only pay next week, it will be 1,500 Rand. So that's incidental to a certain scenario happening, right? But to some sections of an incidental agreement, the NCA will apply. And that's when it becomes a late payment. So let me give you an example. Okay, today I go to the doctor. Okay, whilst at the doctor's offices, I leave and I don't check whether I have a bill because I have medical aid. But I was not aware that my medical aid funds were already depleted for the year, so I was actually supposed to pay in cash for that appointment. Now I have an outstanding bill at the doctor's office. Because I'm not aware of it, I don't pay it, and now it becomes a late payment because 20 business days after it's overdue, the doctor's offices start charging me a late payment fee. They charge interest because I haven't settled my bill yet. The moment that they charge late payment fees and add interest penalties, that's to that specific section, the NTA will apply. So like I mentioned, in normal incidental agreements, it doesn't fall under the rules of the NTA because they just quote two prices and the lesser of two is applicable if you pay before a certain date. But in a scenario where it's a late payment and they charge me an interest or a late payment fee, then the NTA will apply to that specific section. Does it make sense? Okay, Tembiso, I can't see your face, so I'm not sure whether you are okay with everything or not. So please make sure to let me know. Okay.
Okay, I'm okay. I'll just open up the video just now.
No problem. Then developmental agreements, guys. So the reason why these types of agreements are on the list of exception is because what they're trying to achieve with these agreements is growth. The main focus of these types of agreement is not to make a profit, and therefore it won't fall under the strict rules of the National Credit Act. So if it's an education loan, a loan to develop small businesses, loans to either build, acquire, or rehabilitate low-income housing, loans from credit unions, all of these types of agreements where the main purpose is not to make profit, but to enable citizens in our country to grow and to get education, then it won't fall under the rules of the NTA. Okay. And then the last one, public interest agreements. So this is the type of credit that we have available to promote and facilitate credit in the scenario of a natural disaster or a similar situation. Now, they give us examples of floods, disasters, earthquakes, and tsunamis. They are not referring to when your house floods. That's why you have insurance, okay? So this is public, meaning that let's say the entire KwaZulu-Natal floods, and all of a sudden they need to assist with temporary housing. They need to get clean water to the citizens there. They need to get food there, or anything to take care of the general public in a disaster-like situation. That will come from this specific credit. So the best example is, you guys, everyone remembers COVID. No one can say that they weren't aware of COVID, right? So during COVID, on a Sunday evening, our president would come on the TV and he would say, "My fellow comrades, I'm keeping you in a state of disaster." So the reason why he kept us in the state of disaster, for as long as he declared the disaster state we were in, this specific credit was available to our country, meaning that this credit was utilized to get PPE equipment, do you remember all the pop-up hospitals we had, or the pop-up testing stations? And so all the funds that they had to get to assist in this disaster-like situation will come from this specific credit available, okay? That's why it's also not covered by the rules of the NTA, because in this scenario, it's for the general welfare of citizens in disaster-like situations. So it will be silly to apply strict rules if they're trying to assist people during a difficult time. Okay. Now, unlawful credit agreements. I want you to pay attention to this entire slide, okay? An unlawful credit agreement means the entire agreement is unlawful, okay? So the consumer cannot be forced to stay bound to this type of agreement. And the first one is where the credit provider is not registered to act as a credit provider. So if the credit provider extends credit, but they're not registered as a credit provider, the consumer has no obligation to repay the credit because the credit provider was never allowed to offer them the credit in the first place. That's the first criteria of when an agreement will be deemed unlawful. Okay. The second one says where the consumer is an unemancipated minor. So basically the consumer is underage and they enter into a credit agreement. If you are still a minor, you cannot. It used to be 21 years. Nowadays it's 18. If you are 18 or older, you can enter into a credit agreement. But if you are underage and for some reason you manage to enter into a credit agreement, it won't be binding. Okay. The second dot specifically for the consumer is if the consumer is mentally unfit. Okay. This doesn't count if your wife or your husband or your girlfriend or whoever says you're crazy. It only counts if the court declares you crazy. Okay. So if you were declared mentally unfit in any court in our country, you are not allowed to enter into a binding agreement. Why? Because later on, you can come back and say, but I was not in the correct state of mind to make an informed decision. Hence, I can't be bound by this agreement. So now, from the get-go, they just say that if you are mentally unfit, you cannot enter into a binding agreement. Okay. And then the last one says, if you are under debt administration or sequestration, and the administrator did not give consent. So basically, you are under debt review. Remember what we referred to when we said that the convict the parole officer will do anything to prevent the convict from going back to jail. Remember that? So in this scenario, if a consumer is under debt review, they will not consider an agreement that if they, for some reason, they are able to enter into a credit agreement, it won't be binding because they weren't supposed to enter into the agreement in the first place up until the debt review is removed from their name. Okay. So that the first one's the credit provider when they are not registered. The second one is any scenario where the consumer is basically unfit to enter into the agreement. And then the last one says where the agreement is a prohibited offer. Have you guys heard of negative option marketing? Heard of it? Okay, Tian, what do you understand under that term?
It's when a product is being sold without your consent, but you didn't say no or yes. So they take it as you want the product.
They just assume, hey? That's perfect. So negative option marketing refers to assuming that a consumer wants something just because they did not explicitly tell you they do not want it. And this is not allowed by the NCA. So sometimes it happens where the bank just increases your credit limit without your consent, right? It's not allowed because who says you can actually afford more credit, right? And now they're just increasing your limit because, wow, you're a good payer. But actually, it's because they can just charge you more interest if you have a higher amount that you owe them. So negative option marketing, that's the perfect explanation. And it will come up, I think, 2 or 3 more times during the training, is where a credit provider assumes a consumer wants something just because they did not explicitly tell you they do not want it. And that's not allowed by the NCA. Okay, cool. So now I'm giving you another scenario. So Susan entered into a credit agreement using a false ID. The ID states that Susan is 22, when in fact she's only 17 years old. What will the effect of the fraud that she committed have on the agreement? Now, option A says that the agreement is lawful. Option B says her consumer rights under the National Credit Act will protect her in this regard. Option C says that the agreement will lead to over-indebtedness because Susan is a minor. And then option D says that the agreement is unlawful. Which one's correct?
D.
D.
Perfect. Okay. Regardless if she committed fraudulent documents, she cannot be held against that or held or kept bound to that agreement because she is still underage. Okay. Cool. So we just discussed an unlawful agreement, meaning the entire agreement is unlawful and the agreement will basically cease to exist. But with an unlawful provision, it refers to that a tiny part of this agreement is unlawful. So they either fix that part or they remove that part, but the consumer is still bound by this agreement. Okay. So what the different scenarios of unlawful provisions will be if it misleads the consumer to potential fraud, if it determines that the consumer waives certain of their rights that might apply to the credit agreement, if it requires the consumer to acknowledge the receipt of goods or information before the goods or information have been received by the consumer. Also, if it requires the consumer to agree to give up money paid to the credit provider in the event of the consumer terminating the agreement, if it authorizes the credit provider to set off a consumer's debt against an asset or account, and the consumer has not given the credit provider instruction to do that, or the last one, where it requires the consumer to leave items like the original ID documents, bank cards, PINs, etc. with the credit provider. So if any of these scenarios happen, it's an unlawful provision. So the court will either remove it or amend it, but the consumer will still be bound by the contract. They can just not be forced to adhere or comply with an unlawful part. So, like I said, the consequences of an unlawful provision, it will either be removed or amended by court, but the consumer will still be bound by this agreement and the amended part because we cannot force them to comply with an unlawful part. Okay. Any questions so far? Okay, cool. So this is the last court case of the day, guys. And this was a court case between the National Credit Regulator versus Quatro, and it happened in September 2019. So just to think about it clearly, the fact that the National Credit Regulator made a case against this company tells me that they probably received multiple complaints about this company. They decided to investigate themselves, and then ultimately they lodged a complaint against this company as well and gave the court the opportunity to decide what happens with this specific company. Okay, so this is what happened. In July and August 2018, the National Credit Regulator received a number of complaints from consumers who alleged that they had applied for loans from Quatro. And then when taking out these loans, the consumers entered into various agreements with the mentioned company, which entailed in some cases handing over the registration papers of their paid-off vehicle. So I don't know how familiar you guys are with vehicle financing, but the person in possession of the NATIS is considered the legal owner of that vehicle. That's why if you finance a vehicle, the bank won't give you the NATIS document up until the vehicle is settled, because for as long as it's being financed, it's the property of the bank, right? So this already sounds a bit dodgy. The fact that they want you to give your NATIS to them as collateral because they borrowed you money, like, sounds a bit sketchy. Okay, so now also they have to pay the credit provider a monthly rental fee to retain possession of their own vehicle. Okay, keep that in mind. So then, when the consumers were unable to repay their loans, their vehicles were simply repossessed by Quatro. So Quatro then sold their vehicle to settle their debt. And what does it look like on paper? On paper, it almost looks like the consumer purposely or willingly sold their vehicle to Quattro because it looks like I gave you money, you gave me the NATIS document, and then we sold your vehicle, right? It looks like a simple sale transaction. So in this scenario, I don't want to ask you who won or lost the case because I think it's quite obvious who lost the case. But I want to ask you, what is the first question that you should ask yourself about Quattro? Think properly. If Quattro is offering credit to consumers, what is the first question you have to ask about Quattro? I know one of you has to answer, right? So just try.
If they're registered.
Perfect. That's what I was looking for. If they are offering credits, then the first thing we have to take into consideration, but are they a registered credit provider? Because does this sound like the practices of a legal registered credit provider? No, the way that they are acting, it sounds dodgy. Okay, so this is what the National Credit Regulator based their court case on. The NCR claims that a series of transactions which Quattro entered into with the consumers and which formed the basis of their business model were credit agreements in the form of secured loans. Okay, so the moment that they granted these secured loans, they were supposed to be registered. Okay, so now the NCR also submits that these consumer transactions were actually simulated transactions because instead of constituting sale and lease agreements as claimed by Quattro, so Quattro said, oh, we don't enter into credit agreements. This is a simple sale and lease, but it's not because in essence, it was credit agreements when they loaned money to the consumer. The moment that they loaned money, the NCA had to apply to these agreements, and therefore Quattro should have been a registered credit provider. Of course, Quattro is not registered. Therefore, they did not comply with any of the rules of the NCA. They did not even conduct any affordability assessment. So once again, Oprah, they were just granting credit to anyone who asked without considering whether the consumers can actually afford it. And then when they charged consumers rent for using their own vehicle, they were so clever because this was how they hid the fact that they were charging interest or they're getting interest repayments. Remember, they already loaned them the money. The consumer still owed them that money, but now they also paid them a rental fee to use their own vehicle. And that was their way to hide the fact that they're getting interest back. So, of course, these charges and fees were not provided for in the NCA. They were actually well in excess of the interest rates that according to the NCA that they are allowed to charge. And therefore, they're not even guilty of contravening with one, but numerous sections of the NCA. So just to give you a summary, at the end of the day, what happened, the court ordered Quattro to pay all the money back to the consumers, but also to pay a big penalty. And then at that time, they were undergoing liquidation and they closed their doors. But this is the type of people out there taking advantage of someone in dire need of a loan, and they loan the money to you, but at the end of the day, the repercussions are major. Okay, cool. Now it gives us a list of National Credit Act products, credit cards, home loans, microloans, surety ships. Timbiso, what is another word for surety ships? We just did it. I can't hear you. You are muted.
It's agreement.
No. There was one word that I gave you that I told you this is the exact same thing as this. So in the exam, when they ask you what is another term for surety ship, Tian, would you like to go and give it a try?
Credit guarantees.
Perfect. Credit guarantee and surety ship, it's the exact same thing. That's like a Mahala mark, okay? It's easy, it's 1 point, so don't forget it, okay? And then also leases, installment sales, and overdrafts. Okay. So now we've discussed what is a credit agreement. We've looked at the different types of agreements. We've mentioned when an agreement is unlawful or when it has an unlawful provision. But now they want to know what are all of the documents to make up this agreement. So in blue, we say that the National Credit Act requires all credit providers to provide the consumer with a pre-agreement statement and quote before entering into a credit agreement with a credit provider. What should this pre-agreement and quote include? They want the detailed terms and conditions. They want them to disclose all relevant costs, the principal debt, so basically the amount that this consumer is financing, the interest rate that they were approved for, the total amount payable will be the amount that they finance plus the total interest, because that's the total that they will have to repay, the number of installments, all additional fees and charges, and this can either be one single document or multiple documents. But the key thing here is that it must be valid for 5 business days. And when they refer to 5 business days, it excludes Saturdays, Sundays, and public holidays. They will ask this in the exam. They ask you, when referring to a business day, which of the following statements are correct? And you have to know that it excludes Saturdays, Sundays, and public holidays. Okay. So why? Why does the NTA focus so much on providing your consumer with a pre-agreement statement and quote? Because the main purpose of these documents is to give the consumer time to read through them, to make sure they understand the terms and conditions before they enter into the agreement. They want to give them the opportunity to consider all of their options, to consider the financial implications, and then to determine whether this offer is actually in their best interest. Okay, to know if they are taken advantage of. So now when it comes to the cost of credit, guys, the credit providers are limited when it comes to additional charges. Okay, so basically they are only allowed to add a few costs to the initial principal debt. And that will be initiation fee, service fee, interest, changes to interest, cost of credit insurance, default administration charges, taxes, license and registration fees. With this list specifically, if you don't know the list, you won't be able to identify them. So for instance, in the exam, they will say something in the lines of, which of the following costs may be added to the initial principal debt? A, initiation fee, B, spotters fee, C, insurance kickback, and D, license and registration fee. So now, if you know this list, you would have identified that A and D are correct, initiation fee and license and registration fee. So you need to familiarize yourself with this list, please. Okay, then in the event of the consumer missing payments, they are allowed to charge collection charges as well as value of items, but none of these additional charges is allowed to exceed the initial principal debt. Okay. I don't know how familiar you guys are with any financing of items, but if you finance a vehicle, you are obligated to have insurance. If you purchase a house and you have a home loan, my husband and I bought a house, I think 4 years ago, and we were obligated to have life insurance. Because the sad part is that if one of us dies, the bank wants to know that they'll get their money back that they gave to you. Okay, so credit providers may insist on insurance cover. So it's during the term of the agreement, a credit provider can require that the consumer maintain life insurance, mortgage agreement insurance, or any other insurance they deem necessary. But as per the NTA, these insurances may not, in blue, exceed the total outstanding debt owed to the credit provider under this agreement. It may not exceed the full replacement value of a property or the outstanding amount on a vehicle agreement. It may not be unreasonable or at an unreasonable cost. And They are even allowed to include top-up cover or shortfall cover if they feel it's necessary. So let's just go back to the part where it says exceed the total outstanding debt or exceed the full replacement value. What they're basically saying is that you are not supposed to get rich from the insurance payout. The payout should basically settle your debt and just put you back in the same scenario or the same situation you were in before the incident occurred. Okay, can you imagine if everyone got richer from the insurance payout? Some people will willingly drive their vehicle into a wall, hope it's written off because they're getting a lot of money back. Okay, so that's why it specifically states that the insurance should only settle your debts and then put you back in the same situation you were in before the accident occurred or before the vehicle was stolen or whatever. Okay. And then the credit provider may insist that the consumer directs the credit provider to recover and pay the insurance premiums over to the insurer. Okay. So in terms of the documents, your credit agreements, what are the rules when it comes to the confidentiality of client records? All consumer information must be kept confidential. What they tried to say is, if I go to Tian, he's the agent that's assisting me, and I fill out an application with him, if he is unable to assist me, he's not allowed to share my information with Tembiso and just say, okay, but just give me a spotter's fee for giving you the transaction. Okay. If I fill out my application with Tian, it means that Tian's only allowed to share my information with the key role players that need to decide whether I will be approved for credit or not. For instance, the credit provider, the credit bureau, the debt counselor if they suspect any reckless lending, the national credit regulator if there's an investigation on the transaction, and the National Consumer Tribunal to assist them in deciding on what happens if a complaint was lodged. But no one else, not your friend down the road or another credit provider that can offer you a better deal or whatever. It's only allowed to be shared with these specific role players, okay? And then consumers have the right to receive all of their required documents free of charge in any of the following formats. So basically, I signed a contract today. I can ask them to either collect the contract documents in person if I wanted. I can ask them to courier the documents to me, but then the customer will carry the cost of that. I'm not sure who in 2025 still uses a fax machine, but if for some reason you want your contract documents to be faxed to you, best of luck. Okay, most people nowadays tend to use email. It's easier and you can always go back on your emails to find your documents, printable web pages, and then also the ordinary mail. Once again, I don't know if I'll trust the South African Post office. It might get lost along the way, okay? But whatever works for you, that's your prerogative. So consumers are then allowed to request one replacement copy free of charge within 1 year. So basically, I lost my documents. I signed a contract in January 2024. I have up until Jan 2025 to ask for one free replacement. Afterwards, if they have to replace my documents, the provider is allowed to charge me a fee for the replacement of these documents. Okay. And then, guys, documents in an official language. The National Credit Act stipulates that consumers have the right to receive documents in any of the official languages, as approved by the National Credit Regulator. But now what happens in tomorrow's test, they say that the consumer has the right to receive the documents in the language of their choosing. That is not correct. Because maybe you choose to have it in German, but the only approved languages is Afrikaans, English, and Zulu, maybe. Do you understand what I'm getting at? So don't let the way that they pose the question confuse you in picking the incorrect answer. Even though we can get the documents in any of the official languages, It does not necessarily mean that it will be the language of the consumer's choosing, because we don't know if that language is on the list. Okay. And then the last part, also in blue, any changes made to an agreement after it had been signed will be void unless the consumer agreed to these changes, they signed for these changes, it is in writing, and it reduces the client's liability under the agreement. So what happens, tomorrow they give you a scenario where they state that ABC Limited made a change to Mr. John's agreement, but they gave him a call to inform him about the changes. Will these changes be valid? Yes or no? No, because you have to know, are these changes in writing? Did he consent to these changes? Has he signed for these changes? And will these changes reduce his liability? And that's the criteria for any changes to an agreement that's already been signed. Okay. Everyone happy with that part? Did you make a note? It's a guaranteed question. Okay, perfect. Now, when it comes to the statement of account and record keeping, guys, credit providers are obligated to deliver periodic statements to their clients. So usually that's 1 month. That's why at the end of every month, we get our statements from all of the credit providers that we owe money to, okay? If it's an installment sale, they do allow up to 2 months. And if it's a home loan, they do allow up to 6 months, because a home loan, it's such a significant amount that you are borrowing that 1 month's installment that you pay will not make a big difference on what you still owe. So that's why they do allow 6 months between statements. But the part I want you guys to focus on this slide is the record keeping part. So according to the National Credit Act, credit providers are obligated to keep record 3 years from the date of application and 5 years from the date of termination. So the first one, client comes in, client completes an application for credit, and nothing else happens with that transaction. It's maybe sent for checking and everything, but there's no agreement signed. Then they have to keep record of that application for 3 years. Second scenario is client comes in, applies for credit, signs the contract. Now, only when the contract ends are they still obligated to keep record for 5 years of that agreement. Meaning that if the contract's supposed to end in 2027, 5 years from that date, you still keep record. Or if you settle it beforehand, from the date that it was settled, 5 years from that date, record must be kept about it, okay? They won't ask you to calculate the year. They will only ask you, what are the rules in terms of record keeping? 3 years application, 5 years termination. Now I want to mention to you guys, you have one of 5 exams that you can possibly write tomorrow. Okay? I know for a fact that in one of the exams, they ask you which 2 statements are correct in terms of record keeping. But then they give you the option 3 years application, 3 years termination. But so only one is correct, but they ask you which 2. If you only pick the correct one, you will still get all your marks. Okay. But don't let them convince you in picking a wrong one just because they say pick 2. If you know for a fact that only that one's correct, pick it. Okay. 3 years application, 5 years termination. Awesome. Okay, guys. And then when it comes to the cancellation of credit agreements, have you guys ever heard of the word rescinds? You heard about it? Okay, because I know, I just wanted to go check here and see if I can get you a like textbook meaning. So it says to revoke or cancel. That's what rescinds means, right? It's RESCINDS. So now what happens? In the exam, they refer to that the client decides to rescind the agreement. And then all of a sudden, you have no idea what they're talking about. But this is the same slide. So when they decide to cancel it, to stop it, to back out of it, it's the same thing. Okay, so this is what happened. A consumer is allowed to terminate a credit agreement within 5 business days after the date on which the agreement was signed by the consumer, but only if the agreement was entered into at any other location than the registered business premises of the credit provider. Okay, so what happened? The client maybe signed a vehicle finance contract, right? But they took delivery at their home. So the delivery note was signed at home instead of the dealer premises. This is not a registered business premises. So therefore, they have a certain amount of time where they are still allowed to back out of the agreement. Do you know what they call the specific time period? They refer to the cooling off period, guys. Okay, so it gives them time to cool off to decide if they still want to enter it. But it's only applicable if they entered into the agreement at any other location than the registered business premises. Okay, does it make sense? You sure? Okay, so basically, if the cooling off period applies, it means that the client entered into the agreement at any other location, the registered business premises, and they have 5 days to back out, to cancel or rescind the agreement. Okay. Then how do they notify the credit provider? So by delivering a notice in the prescribed manner of the credit provider to inform them that they are planning to back out. Then they have to return the money borrowed or goods or pay in full for any services that they received by the consumer in respect of the agreement. Okay. And then the credit provider must refund the money to the consumer that they already paid under this agreement, and they have 7 business days to refund them after they receive notice of this termination. However, it does allow the credit provider to deduct certain costs. So for the reasonable cost of having the goods returned to the credit provider and restored to a saleable condition. So basically, the credit provider had some expenses to make sure this item was in a certain condition when it was sold to you. If you use that item for 4 days or 5 days before returning it, they are allowed to charge you for the same cost of getting it in the exact same condition that it was sold to you. Okay. And then if it's a used item, they are allowed to charge rent for the use of goods for the time that you had it in possession, in your possession. Okay. So that's everything for contracts. Do we have questions? Nothing. Sure. Okay, cool. This module will probably go by the quickest. It's consumer rights. Okay. So first things first, before we can consider all of the rights of a consumer under the NCA, we have to think about who will be considered a consumer under the NCA. So a natural person, the party to whom goods or services are sold under a discount transaction, incidental credit agreement, or installment agreement, the party to whom money is paid, credit is granted, or under a pawn transaction, the party to whom credit is granted under a credit facility, the borrower under a home loan, the borrower under a secured loan, the lessee under a lease, or even the guarantee provider under a credit guarantee. But now, tomorrow, they ask you, which of the following will be considered a consumer under the National Credit Act? Option A, an organ of state or state itself. Option B, a director or shareholders loan to their own company. Option C, a natural person. Or option D, a juristic person exceeding the annual threshold of 1 million. Which one's correct?
C.
Okay. What are the other 3 options? Timbiso, can you remember? Almost there.
Yes, I do remember.
What are the other three options? Where did we hear about the other three before?
Come again?
The other three options that I gave you now, where did you hear about them before? The one where it says any organ of state or state itself, shareholders loan to their own company, or juristic person exceeding the 1 million threshold.
I heard them when we were talking about the natural person and the, what is that again?
The list of exceptions, guys. Do you recall the list of exceptions? So if we say it's the list of exceptions, it means that those specific transactions are not covered by the NTA, right? So if they're not covered by the NTA, they won't be considered a consumer under the NTA. And that's why all of the other options were incorrect. So the only correct one was the natural person one. Are you happy with that? Do you see how they go back to certain parts of the NTA and combine the question? So if you don't know the list of exceptions, you wouldn't be able to identify that only a natural person was correct in that scenario. Okay, cool. So everything in blue, it's the consumer rights that they ask most often. Okay, so the first one says the right to apply for credit. Once again, everyone can apply. It does not mean they will get it. It does not mean they will be approved. It does not mean they will obtain it. That will be purely based on your credit profile. The second one says the right to be protected against discrimination in respect of granting credit. So tomorrow they'll give you a scenario where they say Mr. Peter's application was declined due to his age. And then you have to identify, but that's discrimination because the only reason they are allowed to decline your application will be purely based on your credit profile, not your age, your gender, your race, or anything like that. Okay. Then also the right to written reasons regarding the refusal of credit, the right to information in an official language. Remember, the official language is not necessarily the language of the consumer's choosing, because we don't know if the language that they prefer is on the approved list as approved by the NTA. Okay. The right to information in a plain and understandable language. Guys, we cannot assume that everyone understands the specific terms in the credit industry. Imagine going to the doctor and the doctor only spoke to you in medical terms. You'll probably think you're dying, but you only have a cold just because you don't understand the doctor's terminology. So that's why they say they are obligated to provide the information in a plain and understandable language. And there, where there's no other way in explaining it, you have to provide definitions to make sure the consumer is completely aware of what you are saying. Okay. The right to receive all documents, the right to access and challenge information, as well as credit records. So basically, if you feel that the information that the credit bureau has on record about you, if you are the consumer, you are allowed to ask them to change it, but you have to supply proof that that information is actually incorrect. Then the right to receive all documentation, the right to access and challenge information as well as credit records, the right to protection of customer credit rights, the right to confidential treatment, the right to cooling off, but it will only be applicable if the consumer entered into the agreement at any other premises than the registered business premises, right? Guys, remember that. The right to apply for debt review and the right to settle an agreement. Then, the National Credit Act also stipulates that every person has the right to be advised by a credit provider within the prescribed time before any adverse information concerning that person is reported to a credit bureau, and then to receive, upon request, a copy of that information. The next part, we can just summarize by saying, how often can a consumer get a free credit report from the credit bureau? We did it earlier.
Once a year.
Perfect. And then lastly, challenge the accuracy of any information once within a reasonable time after successfully challenging any information. So basically, it says that if you are unsatisfied with the information that a credit bureau has on record about you, you provided proof to them that that information is incorrect, you have the right to follow up to make sure that they actually change the information according to the proof that you supplied to them. Okay. And then when it comes to the settlement of agreement, guys, all credit consumers have the right to terminate their agreement at any time just by simply paying the settlement amount. So meaning if your contract is supposed to be for 72 months, but you are able to settle it within 36 months, you have the right to do so, and you don't have to notify the provider of your intention of settling this agreement. So what they do is they simply calculate a settlement amount. And the settlement amount is the total of the unpaid balance of the principal debt at that time, the unpaid interest and all other fees up until the settlement date. Sorry, guys. And then with a large agreement, they do charge an early termination charge. Obviously, if you settle your agreement before the obligation end date, they are going to lose out on interest. So they charge you an early termination charge to say basically that this is your penalty for backing out of the agreement before you were supposed to. So with a large agreement, if the customer signed the agreement on a fixed interest rate, then they will take the early termination charge equal to no more than the prescribed charge that they are allowed to ask. But if you signed on a variable rate, a linked rate, a fluctuating rate, it's the same thing. So if there's no fixed rate, then they have to calculate what the early termination charge will be. And that's usually the interest that you would have paid under that agreement for 3 months' time. That will make up the early termination fee. Okay. But if there is a balance on the paid premiums left upon termination of the agreement, it must be refunded to the customer because it's their money, obviously. And it's such a cliche thing to say, but with every right comes a responsibility. So they say that even though consumers have a lot of rights, it is the responsibility of the consumer to fully and truthfully supply the information requested to the credit provider. It is their obligation to advise the credit provider of the address of the premises where the finance goods will be kept, and also to advise the credit provider of the name and the address of any person who will be in possession of the finance goods. Okay. And then they say, believe it or not, even though the consumer has the most rights, credit providers actually have a few rights of their own. So a credit provider has the right to refuse to enter into a credit agreement with any prospective consumer, but it must be on reasonable commercial ground. So once again, I cannot refuse credit just because I don't like your face, okay? It must be in line with the customary risk management and underwriting practices. So basically, your credit profile won't allow you to enter into this credit agreement, not anything else. They do have the right to enforce a contract, and they also have the right to receive payment for the credit that they have extended to the consumer, along with the interest that the credit provider and the consumer agreed upon. Okay, so that's the summary of the rights that the credit provider has. Do you see why I mentioned that chapter just flies by? Okay, so last 2 chapters, guys, and then we're done. So affordability assessment, over-indebtedness, and reckless credit. Affordability assessment means that we have to check whether the consumer can afford the credit before granting it. Over-indebtedness is consumers who have more credit than that they can actually afford. And reckless credit was granting credit to someone knowing that they won't be able to make the payments. Okay, so let's look at them. What is the purpose of the affordability assessment? It's to minimize reckless lending. So who do we think of when you think about reckless lending? We think about Oprah. Okay, granting credit to anyone who applies without checking if they can afford it. So credit providers should ensure that individuals can afford it before granting the loan, and they do that by calculating disposable income. So disposable income is the amount that you have available to fund this proposed credit. Okay, so what's the formula? So they take your gross income, they deduct your current debts as well as your monthly living expenses. And whatever is left, that's the money you have available to fund this credit that you are applying for. Okay. So then when conducting a affordability assessment, it's the job of the credit provider to firstly calculate the disposable income, to see whatever the consumer has left after paying all of their bills. Then they have to verify the gross income. That's why they always ask for bank statements and payslips, right? Because they want to see whether the amount that you say you get in your bank every month is actually the truth. Also, they do consider all monthly debt repayments and other expenses, and then they make a calculation of your client's existing financial means, prospects, and obligations, and they do consider the minimum living expenses. Okay, so when verifying gross income, if it's a salary earner, they'll ask for the latest 3 payslips and the latest bank statement showing the last 3 deposits. If it's a non-salary earner, they'll ask for the latest 3 documented proof of income or the latest 3 months bank statements. If the person is self-employed or informally employed, they'll ask for the latest 3 months bank statements or the latest financial statements. And if it's a joint income verification, so 2 people applying for credit together, that's only usually with spouses that apply together, right? They have to submit proof of the other person's income, but also consent from that person to do a credit check on their profile. There's different ways on how they verify gross income. So now they calculate the necessary expenses of the consumer. So the credit provider must make a calculation to determine a client's financial means, prospects, and obligations by using the minimum expense table provided for in regulation. Guys, I want you to pay attention. I'm going to give you 2 marks now, okay? Which in, I think the next slide or 2, you're going to have to explain to me, okay? Financial means. According to the National Credit Act, the definition of financial means refers to 2 things. The first one is where they allow you to take into consideration any income, regardless of where it comes from, regardless of the regularity, the frequency, or the source, okay? Any income that you have the right to receive except the income already noted on your payslip. So what they're trying to say is that the NCA allows you to take into consideration all income, not just the income noted on your payslip. So maybe Tembiso rents out a room in his house and he gets a rental income, regardless of where the money comes from, how often he gets it, or what the frequency is. Any income he has the right to receive. Or maybe Tian is a painter on weekends and he sells paintings, and the money that he gets from the paintings, financial means refers to the fact that we can even consider that money as an additional income regardless of where it comes from. Okay, that's the 1 mark. But another mark also refers to that the fact that they do allow you to consider the person you are sharing your direct household with or family member, who not only shares their financial means with you, but also pays mutual debts. Because this whole purpose is to make your affordability look more appealing, right? To make it look more that you have more money available. So let's say the rent that you pay for your apartment is 6,000 Rand. But financial means allows you to declare the fact that even though the rent is 6,000 Rand, I have my boyfriend or my girlfriend or whoever living with me in my direct household who pays half of the rent. So if it shows on my application that I'm not responsible for the full 6,000, I'm only responsible for 3 of it, it will boost my affordability. Does that make sense? So 2 things when you hear financial means: all income, irrespective of where it comes from, and the fact that we pay mutual debts. Please remember it. In 2 slides or 3 slides, I'm going to ask you guys again. Okay, so credit providers will then incorporate this formula in their credit scoring models. Should the consumer's living expenses be lower than the amount provided, a specific form called a Declaration of Consumers Necessary Expense questionnaire must then be completed. And then what do they consider necessary expenses? Accommodation, transport, food, education, medical expenses, as well as water and electricity. Okay, that's what the NTA feels like is expenses that we need on a daily basis to survive. Okay, so now I'm giving you the scenario. I want you guys to actually take a picture of this slide, or Thembiso, if you're going to watch the video again tonight, then it's not necessary, but I know Tian said he's not going back to it, so this is not in your book, but this is the closest you'll get to a textbook definition of financial means, and that's why I want you to take a picture. Okay, so John and Lynn eventually decide to apply for finance for the vehicle that they want, and they're asking for you as the agent to assist them. So John decides he will apply solely on his name because they are not married. Now the bank refuses his application because he does not meet the affordability requirements. And then you as the agent, you refer to John to consider his financial means as defined in the NTA. And you say that the financial means should also be taken into account and not only the salary noted on his payslip. Okay, so choose the correct description for financial means in the option below. You have to take a picture of this as well, otherwise the first one won't make sense. Okay, so hopefully the first thing you noticed was that there was a 2 in brackets. And that 2 refers to more than one answer being correct. You have to pick 2 answers. So option A says financial means according to the National Credit Act refers to excluding irregular income. Option B says financial means according to the National Credit Act includes income or any right to receive income, irrespective of the source, the frequency, or the regularity thereof, but which is different than the normal income that the consumer receives or has the right to receive. Option C says financial means, according to the National Credit Act, includes the financial means, prospects, and obligations of any other adult person in the consumer's immediate family or household with whom the consumers share their respective means, but also pay their mutual debts. And then option D says financial means, according to the National Credit Act, refers to verifying all the income of a client. Thembiso, which 2 are correct? I think you just muted. You just need to unmute yourself.
Yes, for me, it's answer D and A.
Okay, Tian?
B and C.
That's correct. Why did you pick D and A? Remember, Thembiso, when we discussed financial means, I said you look for 2 things. The fact that it includes all income, don't care what the source, the frequency, or the regularity is, all income that you have the right to receive. That's the first one. And the second one I mentioned when it comes to financial means is the fact that you pay mutual debts because it makes your profile look more affordable. So instead of saying that, oh, okay, I have a rental, I pay rent every month of 6,000 Rand. If you have someone in your direct household who pays half of the rent, it will make your affordability look more appealing. So that's why B and C are the correct answers. Are you comfortable with that?
Oh, okay.
You're
Yeah,
gonna
I'm comfortable.
you're gonna
Yeah.
study these two.
Yeah, no, I'm gonna study. It's just that now something is disturbing me.
Okay.
Yeah,
But
yeah,
please,
there's a personal issue that is disturbing me. Yeah.
if you work through the content later on and you don't know why it's a correct answer, just let me know and I'll explain it to you again, okay?
Okay, thanks.
Okay, so then we know another one of the main purpose of the NCA is to discourage reckless credit granting by credit providers, right? So basically when they grant credit without considering the fact that the consumer might not be able to afford it. So now the NCA provides for a compulsory credit assessment before a credit provider will enter into a credit agreement with the prospective consumer. Okay, do you see all of this blue? All of these are marks for your exam. Okay, so when it comes to reckless credit, an agreement is seen as reckless if the credit provider failed to conduct an assessment when the agreement was made. So the credit provider did not take the reasonable care to ensure that the consumer generally understands or appreciates the risk, the cost, or the obligations under the proposed credit agreement. Guys, reckless credit must be reported to the national credit regulator. And then for some reason, you always get the second one wrong. It must also be reported to the magistrate's court, not the tribunal, the magistrate's court. Okay. So when reckless credit is suspected, the financial position of the consumer at the time the agreement was made will be taken into account. So what they're saying here is that if this consumer is a victim of reckless lending, the debt counselor will try to investigate the scenario. And they start the investigation by checking what was the financial position of the consumer before they entered into this credit agreement. Because if there are already clear signs in the beginning that the consumer is over indebted and the credit provider still decided to grant the credit, they did that recklessly, but they first have to determine what was the financial position for the consumer before they entered into the mentioned credit agreement. Okay. So now they want the following documents. The credit provider should then supply the debt counselor with the following document within 7 business days. They'll ask for the application for credit, the pre-agreement statement and quote, the credit agreement, and the record of all payments made to date. But once the court declares an agreement to be reckless, it will be set aside or suspended. So when they ask this question in the exam, they always ask you what happens if an agreement is declared reckless. And the first option they give you is they say that the credit provider can continue with legal action against the consumer. But why will the credit provider be able to charge or continue with legal action if they are the guilty ones? Because they were not supposed to grant the credit in the first place. So that option cannot be correct. The second one that they give you to confuse you is where they say that the credit provider can force the consumer to continue payments under this agreement, which is also not true because the credit provider took advantage of the consumer. The consumer is a victim. So the only option you look for is when an agreement is declared reckless, it will be set aside or suspended. That's the only options. Okay. Take a picture of this slide. I made a summary for you. Okay. The reason is that we realized after a few exams that people get confused between an unlawful agreement versus a reckless agreement. So an unlawful agreement is where the credit provider is not registered and they're granted credit, or where the consumer is underage, mentally unfit, or undergoing debt counseling, and they were never supposed to enter into the credit agreement in the first place. Or lastly, if the agreement is a prohibited offer, referring to negative option marketing. And that's where Tian said that that's if you assume a client wants something just because they did not explicitly tell you that they do not want it. So in all these scenarios, if the court declares a credit agreement to be unlawful, all of the provisions for that agreement will be unenforceable. A reckless agreement means that the credit provider did not conduct affordability assessment. Or maybe they conducted the assessment, they even concluded that the consumer does not understand the risks, the costs, the obligations created by this agreement, but they still chose to enter into this agreement with the consumer. So this side, this is the Oprah side, where clearly this person should not have been approved for credit, but they just gave the credit regardless. And with reckless agreements, it will be reported to the NCR and the magistrate's court. And if it's declared reckless, it will be set aside or suspended. Do you get the difference between the two? Okay. Cool. Then over-indebtedness. So a person is seen as being over-indebted if at the time of the assessment, we have indications that the consumer either is or will be unable to fulfill their current obligations under the agreement that they have made. So then the credit provider must consider the likelihood of the consumer being able to satisfy their obligations in a timely manner. Okay, and then when it comes to debt review, this is the process that they have to follow. So upon receipt of a debt review application, the debt counselor will firstly notify the consumer that they have received the application. Then the debt counselor has to notify all the credit providers that are listed in the application that this consumer will now undergo debt review. But also they have to notify the credit bureau. Why? Because they want to make sure that if this consumer applies for credit anywhere, that they are declined because they first have to settle their current debts before they can get access to new credit. And then a debt counselor who has accepted the application must determine whether the consumer appears to be over-indebted and whether any of the consumer's credit agreements appears to be reckless credit. Once again, if they see that it is a scenario, so they'll start at the beginning of the agreement to determine the financial position, because if that credit provider granted credit recklessly, the agreement will be declared reckless and set aside or suspended. So this is a quick and easy guide on what happens for application for debt review. If the consumer is not over-indebted, the debt counselor will simply reject the application. If the consumer is not over-indebted, but they are likely to experience difficulty in satisfying their credit obligation, then they will recommend the consumer and the respective credit provider voluntarily consider and agree upon a plan of debt rearrangement. Or if the consumer is already over-indebted, then the debt counselor will issue a proposal recommending that the magistrate's court make either or both of the following orders. So declare one or more of the consumer credit agreements to be reckless, which will then be set aside or suspended, or they will give instruction that one or more of the consumer's credit agreements be rearranged. So how can they rearrange your debt? Either they will extend the repayment term, meaning that the consumer was initially supposed to pay back over 60 months, but now they have to pay back over 84 months, okay? Or postponing payments for a specific date. So they call this a payment holiday. And that's where they say, okay, for the next 6 months, you don't have to repay, but you have to get yourself in a better financial situation. And then the last one is where they reduce the payment amount. So maybe you owe the bank 100,000 Rand and they say, listen, as long as we get 80,000 Rand, we will write off the remaining 20,000 Rand. Okay. Happy. This is the last chapter, guys. So complaints and disputes. The National Credit Act has adopted procedures to ensure that complaints of consumers and credit providers are handled equitably, consistently, in a timely, efficient, and courteous manner. Okay? So, any person can submit a complaint of an alleged contravention to the National Credit Act to the National Credit Regulator. And then the National Credit Regulator is allowed to submit a complaint in their own capacity. I don't want you to focus too much on this slide. They do not ask it quite often because this is just the different reasons of why the NCR will apply to the NTT. So if it's for an order resolving a dispute of information held by the credit bureau, or if it's for an order compelling the delivery of a statement of account or the review of a statement, or maybe if they want to review the conduct of a sale of goods or distribution of proceeds of the sale. So this one is, for example, what happened with Peter. Peter wanted them to review the conduct of the sale because he said that the salesperson took advantage of him. Do you remember that? Okay. Then for leave to bring a complaint directly to the tribunal, or for an order condoning late filing. That's different reasons why the NCR will apply to the NTT. So this is what happens. If upon receiving a complaint or accepting a complaint, the National Credit Regulator will either issue a notice of non-referral. So basically they get a complaint, they look at the complaint and they say, this is not serious, you're wasting my time. They issue a notice of non-referral. Or if they refer the complaint to a debt counselor, if they find evidence of reckless lending. That's what happened when they just received the complaint. Now they get the complaint, they decide to investigate the complaint, and then one of the following decisions will be made after the investigation has been completed. So once again, they issue a notice of non-referral. So maybe the complaint looked serious, they investigated, and after the investigation, it's not serious, then they'll issue a notice of non-referral. Or they can make a referral if they believe that the person has engaged in a prohibited conduct. They can make an application to the tribunal if the complaint concerns a matter that the tribunal will consider upon application. And then lastly, they can even refer the matter to the National Prosecuting Authority if the complaint concerns an actual offense. Okay. And this is the last two slides, guys. So negative option marketing, I think this is also something that you can say in your sleep now. Okay. So negative option marketing refers to the assumption that a client wants a product or a service just because they did not specifically tell you they do not want it. This is not allowed by the NCA, and it will be an unlawful agreement if this takes place. Okay. Then marketing and sales at work and home. So a credit provider or an agent may only enter into an agreement if the visit was pre-arranged by the client for the purpose of discussing such agreements. And then if the credit provider visited the client to offer goods or services and then incidentally offered to provide finance for these goods or services. But if visiting the person's place of employment or home, the agent may not incentivize the employer or the trade union that introduced the sale. And remember, the cooling off gives the customer 5 working days to back out of the agreement, to rescind the agreement, or to cancel the agreement. It's all the same thing. Okay, but only if they entered into the agreement at any other premises than the registered business premises. And then the following, this is the rules of the NCA when it comes to ads, okay? Credit providers are not allowed to advertise unlawful credit. None of the advertisements may be misleading, false, or deceptive. So if they only say conditions apply, it's not allowed, because what are the conditions, okay? If they sell an installment, they have to disclose the interest rate, the credit cost, the term, the deposit, and the balloon payment that they use to calculate that specific installment. And then Customers must be given the option to be excluded from telemarketing campaigns, marketing or consumer lists, or the mass distribution of email or SMS messages. So basically, if your client says, I don't want to receive any ads from you, you have to make a note of that request. You have to keep record of that request, and you're not allowed to contact them again for marketing purposes. Okay, so that's it. That's all of the training, guys. This is just the last few tips on the exam. So firstly, please remember to pay attention to mark allocation. If it wants you to pick more than one answer, if it asks you which two options are correct, or if it gives you a square, pick more than one answer. Okay, if it's a circle, only pick one. Look out for negative questions. Your brain is programmed to always look for the correct option. So now when they say which is not a function, you first have to identify the function to eliminate them, because then you'll know which is not a function. So for instance, which is not a function of the NCR? We know that the NCR is responsible for the registration of the credit bureau, credit provider, debt counselor, and payment distribution agents. So B and D is functions of the NCR. So which is not a function? A and C. Do you see how easily it's to eliminate it if you know the content? And remember, the reason why tribunal members are not correct, because they are actually appointed by our president. Okay, and then the last one, trick questions. So they ask you, what are the requirements for deposits in terms of the NTA? Option A says only deposits on pre-owned vehicles are required. Option B says 12% deposit on new vehicles since July 2006. Option C says a minimum deposit of 15% on a new vehicle since July 2006. And then option D says, but there are no requirements regarding deposits in terms of the NTA. Did you guys hear anything about deposits today? Okay. But now, just because they give you a month and a year, all of a sudden you guys think it's legit. And then you're like, it has to be that one. But they try to trick you, and then you doubt yourself. Okay. This is just an additional court case. If you enjoyed reading court cases, this entire court case was based on at arm's length, and it's very interesting, but you don't have to prepare it for the exam. So if you want me to forward it to you on WhatsApp, you can just let me know. Okay. And then, last thing, I want you to log into the portal and let me know if you can log in or not. When you attempt the exam tomorrow, only use Google Chrome. So the people who set up our learner portal, they advised us that the portal's most compatible with Chrome. So Tembiso, I don't know on which device you plan on writing your exam tomorrow, but if you plan on writing it on your phone, I want you to make sure you download the Google Chrome app today so that you don't have any issues when you have to log in tomorrow. Okay. And then I'm going to share two videos with you guys. The first video is just to show you on how to clear your cookies. I don't know if you know how to do it. If you do, that's great. Then I won't send it to you if you don't. But it's just to make sure you don't have any pop-up issues tomorrow. And the last one will be to make sure your webcam settings are correct. Because when you log into the exam, the camera is switched on in the background. You won't be notified. Remember, it's not for your sake to see if you are recorded. It's for the invigilator of the IOB SA. So sometimes people say, oh, but I can't see if the camera is on. So if you do these steps, okay, it will be switched on in the background and you don't have to worry about it. Okay, cool. And then tomorrow when you log in, this is the screen that you will see. So if you log in at 8:30, you will see nothing. It will actually say you are not enrolled for any courses. Then at 1:45, you can refresh and you will see the exam. Then you can read through the exam instructions, but that blue button at the bottom that allows you to start your attempt will only be available, I think, around 10 to 9 tomorrow morning. Okay, any questions? Sure. Okay, best of luck, guys. Please remember to do your mock exam before 3 o'clock. You have to have 85 or more. Don't use your study guide because that will give you an indication of how much you still need to prepare for tomorrow. Okay. Make me proud. Bye.